Hey everyone, my name is Josh Martinez, and I appreciate the opportunity to communicate with you and to share with you a strategy demonstration. We're going to utilize a strategy known as Destination Trader, and it works inside of the futures market. Now, we do like to monitor the major indices such as the NASDAQ 100, S&P 500, E-mini Russell 2000, etc. We do like to utilize the contracts that give us the ability to trade with micros, which are relatively new to the market, to the CME Group, Chicago Exchange. About 2 calendar years it was introduced. Essentially, we can now trade with 1/10 the average investment of a full E-mini, which can allow risk management to be much easier to accomplish. I just want to give a big thank you to InvestorExpos for allowing us to host and to share with you this strategy. It's always an honor to be on here. Before we get started, if you could please be so kind to type in a yes into the question section box. Just let me know you can hear my voice. That'll let me know that everything's working properly on my end, as well as everything's working properly on your end. If you're looking for that question section box, you can click on the orange button with the arrow on it, and that'll open up your control panel. Down at the bottom says enter a question for staff. Hey EG, hey Pat, hey David, hey Trader, John, Caroline, appreciate the opportunity. Thank you so much for joining us. Okay, so before we get into the strategy demonstration, in front of you is the risk disclaimer. Just means that there's risk involved. You should never invest money that you cannot afford to lose. Always keep risk management in mind. Understand that we are not CTAs, which stands for Commodity Trading Advisors. And what that basically means is what we're going to share with you is research. And what you do with this information is completely up to you. Now, we are not money managers, so we'll never ask you to give us money to trade on your behalf. And look at us more like a newspaper. We're going to share with you this research according to the strategy and according to our experience. But ultimately, what you do with this information is completely up to you. Now, we do utilize what's called back-tested results. Back-tested results are hypothetical or simulated results. Before we enter into a trade or pick a strategy to enter into the market, we like to ask the important question, which is, what would the performance have been if I have been doing this for the last month, the last 6 months, the last year, and so on and so forth. So you're going to see some back-tested results today with the strategy that gives us the ability to see what the win-loss ratio is, what are the drawdowns, what's the profit factors, and so on and so forth. Before I jump into the live market, let me just introduce myself. My name is Joshua Martinez. I'm a 10+ year training veteran. Personally, I've taken a $500 US initial deposit investment and made a little bit over $39,000 US of profit from it. It took about 2 calendar years to accomplish that. Full disclosure with it, I treated it like a bank account. I opened up the account with 500. When I could, I put more money in. When I needed it, I took money out. I'm a senior course instructor at Traders Agency, published author, international speaker, professional analyst. I've trained tens of thousands of people from all around the world, and I'm a full-time analyst myself. What I do is I share strategies, and I teach strategies to people who want to know. I share my research to those who want to know. Some of my information has been published in Your Trading Edge, FX Trader Magazine, Equities.com, Trading Pub, as well as TraderPlan.com. So with that being said, let's go ahead and jump into the live market. So some people have never traded before, and some people have. And so for the people who are relatively new and you're kind of on here, you're curious, you're trying to learn something to kind of make the decision on whether or not you want to be a trader, whether or not you want to invest, let me just quickly share with you what we're looking at. So this is called a chart, and what we do when a person decides to make the decision to trade their own money, they typically will monitor price movement over time. And you can accomplish that by utilizing charting software. Now, I'm utilizing TradingView charting software. It's an internet-based chart, so there's nothing to download, and it's quite neat. But what we're looking at, these are known as Japanese candlesticks. And these Japanese candlesticks, they capture price movement over time. On the bottom, you're going to see the time and the date. On the right-hand side, you're going to see the price. As I talk, as I communicate, price is going to go up and price is going to go down as I'm talking, because it's a live market. If you see a green candlestick, it just means that price went up during that period of time. If you see a red candlestick, it means price fell during that period of time. On the upper left-hand side, you can typically change the amount of time you want to capture. So we are viewing what's called a 5-minute time frame. which means every one of these candlesticks represents 5 minutes of trading. So at the end of the day, the overall job and the overall goal here is to be able to make a decision, up or down, buy or sell. In the futures market, what we do is we will make a financial bet based upon future price movement. We are basically saying, hey, we bet that price will go up, and we're going to define how much money we're willing to lose or how much money we're willing to risk for the opportunity to make some money. And if you're right and price goes up, you make some money. If you're wrong, price goes down, you lose some money. If you can also make a financial bet if price were to fall. If price were to fall and you're right, you make some money. If price goes up and you bet the price is going to fall, then you lose some money. So at the end of the day, what I like about the futures market is you can close your eyes, you can put a blindfold on, you can flip a coin and simply guess the direction, and you have a 50% chance of being right and a 50% chance of being wrong if you just randomly guess. What we're looking to accomplish as traders is we're looking to find some sort of sequence of events, some sort of underlying pattern, some sort of technology, some sort of information that can help us predict future market movement and be accurate or be right more than half the time. Type in a yes, why yes in the question section box if that makes a little bit of sense. We don't really have a goal to win all the trades. We try, but we understand that's not reality. We're just trying to win more than half the trades, and with good risk management, we should find success over time. Now, if you look at this market, we have to make the decision up or down, buy or sell. Now, I will say that risk management is the most important thing to trading. And I think any seasoned trader would agree with that. If you are the type of person that risks all of their money in a single trade, then it just takes one trade to lose all of your money. And so you do not want to take that approach. Traditionally, good risk management means staying power. You usually give yourself the ability to lose more than 10 trades in a row. Even though you probably won't lose 10 trades in a row, you always give yourself the ability to lose over 10 trades in a row so that you can have some functioning power and staying power. It's always a good thing. Okay, so a strategy or a pattern that we like to utilize is known as the destination trader, and that's what we're going to demonstrate today. So what is the destination trader? Well, the destination trader is a formula, and it forward predicts based upon a formula and a sequence of events what the market may do next. And specifically, it takes 120 minutes of time. Then it will take the high price, the low price, and the close price of the 120 minutes of time. It will run a formula, and it will place dots on the charts. And there is up to a 9 out of 10 chance that price will move to the expected price movement. Now, what does that mean? It means this. Every 2 hours, we will be provided a price, either above the market or below the market based upon a very specific formula. And the market has a habit or a history of moving towards the predicted price up to 90% accurate. Now, let's go through this one by one. So let's see if we can make this relatively simple. Below this market, you have these purple dots, and I'll put a blue line on it. There is up to a 9 out of 10 chance that price is going to fall. And if your job as a trader is to make a financial bet based upon future price movement, and you have an indicator or a strategy or a methodology that can help you predict what the market may do next, even if it's just a short-term move, and it's right up to 90% of the time, then in theory, you're going to have a huge competitive edge on the market, and you should be able to win more than half your trades. With good risk management, you should be able to find some success. So here's the market. If you were to trade this, you'd probably want to look to sell the market or wait for the market to fall before you buy, because there's up to a 9 out of 10 chance the price is going to drop. Now you'll notice how price came down and has begun to push, and bingo, price equaled the expected destination. Now, that expected destination or that price target is now considered fulfilled, and we will no longer utilize that information. So now, above the market, you have some destinations. You have one right here, and you have one right here. Now, there is up to a 9 out of 10 chance that price is going to fulfill these projected destinations. And so, if you are a trader, you would just basically understand that there's up to a 9 out of 10 chance that price is going to increase and fulfill these levels. So let's see what happens. Along the way, the market will provide additional destinations, and we would anticipate the market to fulfill those as well. Do me a favor, type in a yes in the question section box if you can visually see that thus far the destination has predicted price movement has worked 1, 2, 3, 4, 5, 6 times thus far. Okay, so now we're going to just wait for the next one, and here's one below the market. Now, what I want to do is I want to try to share this information with you in a useful manner. So think about this for a moment. EG says, does the destination stay active once the new one is posted? Great question. So a destination is considered active until price equals it. So for example, we have a new destination that just presented itself, and price has yet to fulfill this destination. Once or if the market fulfills that destination, it will be considered no longer active. So we would want to utilize techniques such as counter trend line breaks, candlestick formations. We want to utilize an entry strategy to trade towards this destination that has yet to be hit. Now, you can see there's another destination below the market. Both of these are still active. But what this is really saying is, hey, Mr. Trader, Mrs. Trader, there is some selling pressure starting to build up, and according to probability, we're going to expect the market to have a relatively larger than normal drop. Now, you can begin to see market came all the way back down and hit that destination. So this one has been hit, this one has been hit. Once this one was fulfilled, you can see the market reaction off of that, and it is now complete. Once it is fulfilled, we no longer trade towards it, and now we have to wait for the next one to be fulfilled or to present itself. Okay, so that one was hit within the first 5 minutes. We're waiting for one to kind of give us an opportunity. Here's one. Okay, so let's try to make this as useful as possible. Let's just say, hypothetically speaking, you are using this information and you turn on your computer and you see there's a destination below the market. There's up to a 9 out of 10 chance that price could fall. And now you have to make, if you choose, make a decision. Type in sell if you believe that you should look to sell the market if you wish to be right, according to probability. Type in buy if you believe the market's going to continue to go up, assuming you're utilizing this strategy, right? So David says sell, Peter says sell, EG says sell. So we're based upon the probabilities, saying, hey, we're going to sell the market would be a relatively strong idea, because according to probabilities, we have up to a 9 out of 10 chance it's going to drop. Now, it may not go down right away, and that's okay. We can utilize an entry strategy to help us sell when the market's falling. So let's see what happens. So along the way, we have these other destinations that present themselves. It doesn't mean that this market won't fulfill. It just means it's going to take a little bit longer for it to come down. And so let's see what happens. A little bit of sideways movement, but then you can see, bingo, market comes right back down. All right. So member says, do you use volume? Where is the volume? So because we're monitoring the major indices such as E-mini Russell 2000 index, S&P 500, we're monitoring the NASDAQ 100. Those are some of the most liquid symbols, and so we don't typically utilize volume in the futures market. What's neat about it is we're not picking and choosing from thousands of different ticker symbols. There's only so many contracts that we can trade, which is nice, because it's almost like if you can imagine, it's almost like all of the traders are isolated to just a manageable amount of ticker symbols. So there's usually enough liquidity. Okay, so one of the things that we want to do, and I'm going to share with you an entry strategy in just a few moments, but one of the things that we want to do is we like to show, not tell. And when we say, hey, this has worked up to 9 out of 10 times or 90% of the time, it can be relatively hard to believe. And so the only way that we've been able to show that, to share the information, is to simply share the information. So what we're going to do here is we're just going to bring in a handful of destinations, and we're just going to ask a simple question, which is, hey, how many times does this actually work? So if a destination is giving us a price point every 2 hours, how many times is the market actually going to the projected or to the predicted price point? But how many times is it actually working, and how many times is it not working? So we'll just bring in a handful. We'll count them from left to right, and we'll do our best to answer. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43, 44, 45, 46, 47, 48, 49, 50, 51, 52, 53, 54, 55, 56, 57, 58, 59, 60, 61, 62, 63, 64, 65, 67, 68, 69, 70, 71, 72, 73, 74, 75, 76, 77, 78, 79. So we have 79 destinations on the chart. And of the 79, let's find out how many times did it not work. It did not work here. Price never came and equaled that destination. We can say did not work there, but actually it did work there. So of the previous 79 destinations, with this latest retracement, 78 have been hit. And if you look at the strike rate, 78 divided by 79, this has worked 98.7%, 98.7% strike rate. Now, a strike rate is different than a win-loss ratio. A strike rate is just, hey, how often percentage-wise is your pattern working? And the only way that we have been able, in theory, to have a win-loss ratio to be equaled exactly to the strike rate is to trade without stop losses. So if a person is willing to have unlimited risk, then in theory, yes, you could equal the win ratio. But that is the most dangerous thing a person can do. What we like to do is manage risk. And so when we bring in an entry strategy and we define and say, hey, this is how we want to enter in, this is how we want to protect ourselves, then we're going to have a trade-off. To protect the account growth by managing risk properly, we're going to lower the the win-loss ratio compared to the strike rate. And all that really means is we end up somewhere around the 70-30 split, which means for every 10 trades we place, we anticipate to lose 7, and we anticipate to lose 3 out of 10 trades, and we try to win 7 out of 10 trades. That's kind of the trade-off. So what we want to do now is we want to share with you the entry strategy, or a way. But before we share with you the entry strategy, let me just ask you, if you have a pattern recognition technology, if you have something that's on your chart that can help you forward predict what the market may do next, and it has worked 78 out of the last 79 times, type in a yes, why yes, into the question section box if it would make a little bit of sense to you that maybe, just maybe, we should trade towards the unfulfilled destinations if it has such a high success rate. Active trader says yes. EG says yes. Peter says yes. Donald says, can this be used for stocks? It can, and some people do utilize it, but you'd be considered a short-term trader. And if you were to, in theory, day trade in the stock market, just make sure that you have enough funds to be classified as a day trader. In the futures market, you do not need to have $25,000 in your account to day trade in the futures market. Some brokers let you open up accounts with as little as $400. But if you were to do this in the stock market, yes, it does work, but just understand that you would want to make sure you can fund the requirements. Okay, excuse me. Let's share with you the entry strategy that I like, a little bit of a backstory on the entry strategy. The entry strategy that I like to use, I utilized it first inside of the Forex market. Inside the Forex market, before I traded futures, I traded the foreign exchange for about 10 years. And I utilized a diversification entry strategy, which allowed me to go about 20 calendar months in a row of continuous gains. It's a under-risk approach, and it's designed for consistency. It does not mean that we win all the trades. It just gives us the skill of turning losing trades into winning trades. And let me kind of share with you what I mean. I call this the old way of trading. And the old way of trading, in my opinion, is when a person says to themselves, I would like to invest $500 into something, that's what I'm willing to risk, that's what I'm willing to invest. Normally what ends up happening, from what I've seen, as a person, they will monitor the market, they'll see an uptrend. A person would then will say, okay, well, here's my uptrend line. And when or if the market pulls back, that person will then say, okay, I'm going to look to buy the market. I'm going to place my stop right underneath my entry, and then I'm going to have a limit up top. So this is pretty normal stuff. It's pretty practical. Most people do it. They will buy the market at a low price in the uptrend. They'll snug their stop right underneath it, and then they'll have a limit. So this is the limit. This is the stop. And this is what I've seen to be a popular outcome. Market goes up, market goes against them, the person gets stopped out, and then the market goes for them. So in trading, sometimes what can happen is we will try our very best to minimize risk by utilizing an automatic exit for loss, and sometimes that stop loss will prevent us from finding success. And this becomes a challenge for a lot of new people. Now, if you can be open to a different perspective, I call this the new way of trading. It's not really new, it's just probably new to you, but instead of investing $500, you would invest $100 up to 5 times. And what will end up taking place is you would say, okay, I see a low price. I would like to buy the market here. But if by chance the market goes against me, I'm willing to buy it again a couple times before I close out my trade. And it's called a diversification entry strategy, where you have a larger stop and ticks, but you're investing less money. So instead of buying it for $500, you just buy it for $100, and you're spreading your investment across a bigger picture. And that usually gives a person an opportunity to play off the waves. So, for example, you buy the market goes against you. When or if it goes against you, you enter in with another $100, and then ideally the market goes for you, and you get to make money for being right in your analysis. Let's just say by chance you're wrong, and the structure that you're trading completely breaks. So the market was making higher highs and higher lows. You came in, you bought where you thought the market was going to go. You bought it again. Now you're recognizing my trend has been broken. I'm in the sell zone. I got to get out of this trade. Oftentimes, through a diversification entry strategy, you can cost average out of your trade. So your first trade will lose some money. Your second trade breaks even or makes some money. And then your third trade makes up the difference. And then you can actually exit with break even, or a little bit of a loss, or a little bit of a gain. This skill can help a person turn losing trades into winning trades. If by chance you completely miss and you're completely wrong and you get stopped out, you're just going to lose. And that's the part of trading that we all have to balance, is preventing ourselves from losing more than what we're making. And we can't avoid all the losing trades, so we have to plan for them. The allocation of losing trades that we like to allocate is about 30% of our trades. So every 10 trades we place, we automatically anticipate that we're going to lose 3 out of 10 trades no matter what we do. Okay, so think about this for a moment. What if you utilize a diversification entry strategy? You're able to play off the waves. You learn the life skill of turning losing trades into winning trades. And what if you use that entry strategy to trade in the direction of the destinations that have worked 78 out of the last 79 times? Type in a ME, M-E, into the question section box if you believe something like that could work. Trader says me, EG says me, Dennis says me, active trader says me. Okay. So the reason why we asked that question is because we asked that question too. And what we ended up doing is we ran some hypothetical scenarios, and we created an entry strategy, and then we automated the process. What you're looking at in front of you is the back tested results on the E-mini Russell 2000, utilizing a diversification entry strategy, trading in the direction of the destination. And these results are from April 1st, 2020 until today's date, February 25th, 2021. And we look at the summary, it is winning 97.1% of the trades. Out of 551 trades, 535 of them have produced profits. It is averaging $12,020.32 a month on average. That is over 11 calendar month period. It is, you can do this completely automatically if you wish, and you will have all the control. Now, full disclosure on the technology. This is not a black box system. This is not a robot. This is not a set and forget style of trading. You're not going to put money in here and then just prints money for you over and over and over again. That's not how this works. This follows all the regulations of utilizing a technology. It's referred to as a self-directed automation, and we look at it like a calculator. So if you imagine that there's a calculator on your desk, if you do nothing with the calculator does nothing. It does not perform on its own. But the moment that you tell the calculator what to do, it will perform the way it's been designed. That's how this works. You have all the control. You pick and choose if you want to buy or sell. You pick and choose how low you want the market to be before you enter in the market. You pick and choose your own stops. You pick and choose your diversifications. You pick and choose your own symbols. You're in the driver's seat. Let me show you some of the statistics, or show you what's actually happening here. So the way that this is working is, hopefully you're going to see it's doing exactly the way it's been designed. It does not win all the trades. There are losing trades. But what happens is there's a destination above the market. It's going to follow the statistics and follow the probability. We have up to a 9 out of 10 chance the market's going to hit the destination. So we enter into the market. As the market goes against us, we strategically size into the trade. So here's a buy, and there's a second buy. And then the market goes to the destination. Once the destination is hit, the trade is closed. So there's a buy, there's a second buy, there's the exit. Now this could be done completely automatically under your guidance, or this can be done manually. So somebody can manually trade it, or somebody can utilize the automation. Now currently, we are not taking sell trades. The markets are very, very bullish, and so we're only focusing in on buying. So right now we have it for direction on long only. And the reason why we do that is because, according to the statistics and probability, if you trade in the direction of the trend, you traditionally can avoid losing trades, and you can begin to replace what would have been a losing trade with a winning trade, and that does help with the P&L. So here's the destination above the market. There's the entry. There's the diversification entry. So that's 2. So instead of losing the trade, we're in the trade 2 times. We're using good risk management, and as the market touches the destination, we exit the trade. Do me a favor, type in a yes, why yes, into the question section box. If you can see, this is everything in which we demonstrated in the manual strategy. So every 2 hours, we get a destination, which is these price points, these lines on the chart, and the goal is to trade towards them strategically. We do have people who are utilizing this strategy now, and this is what some of them are saying. Now, this is a mixture of testimonials. We pull these testimonials from Facebook. We will pull them from Google reviews, and we also host 5 live presentations every week as a company. So Monday, Tuesday, and Wednesdays, we host live trading sessions from 7 a.m. Eastern Time to 9 a.m. Eastern Time. On Tuesday, we host Kickstart classes, and on Thursdays, we host questions and answers. So these could have been pulled from there as well. Terry reports 67 trades with a 94.03% success rate. It says still on demo, which we highly recommend that all new traders start out with a demo account for at least 25 trades before they make the decision on investing real money. We want you to see this in action, and we want you to be comfortable with it before you put any money behind it. Angelo reports a very higher than average day, over $9,980 US. Some people do find success like that, but that's not the expectation that we have for everybody. The expectation that we have is just a modest $3,000 to $4,000 a month is a nice first base goal. Destination trader this week is giving me a 92% win rate. This person said they turned on the destination trader last night, and they're up $1,300. This person reports making $227 when fulfilled their destination. This person says, Josh, I received my statements, 35 trades, 3 losses. That's a testament to your terrific teaching. Thank you so much. This person reports making about $1,300 US. They're utilizing the destination trader. This person made about $2,500 US utilizing the destination trader. If we go to Google reviews as a company, and we type in traders agency reviews, we're not a perfect company. nor do we claim to be, but we are a company that does their very best to learn from their mistakes and to follow the golden rule, which is to treat others the way we want to be treated. We have 248 reviews on Google, and we are a 4.9 out of 5-star review. LETH, about a day ago, says, Josh and the whole Traders Agency is the way to go if you really want to be a good trader. Gives us a 5-star review. Rolly, 5-star review. George says, one of my favorite mentors. Josh is for the people. 5-star review. OG, 5-star review. BUH, 5-star review. Lance says, amazing job, Josh. Truly changed my life. Much appreciated. Easy to follow. This was a career changer for me. Ricardo says they are very professional. Education hub into Traders Agency is useful. The education process they have is very affordable. So I would recommend that you go through some of these and kind of look at the experience that other people are saying they're having. And the reason why we like to show this social proof is not to say, look how good we are. I think our track records and the performance of the strategies speak volumes on that aspect. We like to share the testimonials of other people simply because we understand that some people have never heard of us. And whenever we utilize or decide to work with another company, we like to look at their reviews as well. And the reason why we like to look at reviews is because if people are reporting similar outcomes that we're searching for, then that gives us confidence that we'll probably get what we want. And the reason why we share this with you is to say, hey, these people, they're reporting success, they're reporting happiness, they're reporting value, they're reporting a great experience. And if those are the kind of things that you're searching for, then we could be a good fit. Okay, so I have about 5 minutes remaining in the session. And before we end the session, I just want to quickly provide a promotion. And we're going to invite everyone in the room for the opportunity to try this strategy if they choose. And I want everyone to understand that we here at Traders Agency do our very best to earn trust. We do not expect trust to be given to us. And so one of the ways that we want to try and earn your trust is we want to take on all the financial risk of educating you. And so if you were to sign up to our program today, just understand that you will receive a 60-day 100% money-back guarantee. We invite you to go through our entire program. Use the indicator, use the automation, use the self-directed automation, go to the live class, use the checklist, use the manuals, attend the 5 live presentations a week if you wish, if you choose, join the live training sessions, go through it all. And if at the end of the 60 days, if you say, hey, you know what, this just isn't for me, we'll give you all your money back and we'll still pay our staff for, because at the end of the day, our staff still has to get paid, but we'll still give you your money back. So we believe that is a very fair approach. Now, you've seen that we are a 4.9 out of 5-star review. You've seen the demonstration of the strategy. You know you can manually do it or you can automatically use it. You see the back tested results of the last 11 calendar months. Type in a ME, M-E, into the question section box if you would like for us to share with you how you can join this program for virtually a risk-free opportunity. So Pat says me, EG says me, Terrence says me, Trader says me. Okay, so this is called a destination trader, and it is a trading strategy designed for consistent returns. It is user-friendly, simple, out-of-the-box ready. It works on TradingView and works on NinjaTrader 8. You will receive a 4-hour class. It will be recorded so you can review it as many times as you wish. You will receive the Destination Trader Calculated Indicator. You get 2 strategies, 4 checklists, how-to videos, online education portal. You get Kickstart classes and the recording of the Kickstart classes. The value is $11,276 US. That's just the value, not the cost. You get the online education portal, so as soon as you sign up, we will send you a welcome email with the username and passcode, and you get immediate access. Think of this as your online university. You get your live class demonstration. That's going to be in a couple weeks on a Friday. It will be recorded so you can review it as many times as you wish. You get the Destination Trader indicator on TradingView, and you get the indicator on NinjaTrader. You get them on both. You receive your Destination Trader self-directed automation, the technology that can automatically trade under your guidance. You receive that on NinjaTrader 8 as well. You get checklists, which will outline specifically what to do step by step by step. We will also host 5 live presentations every single week. 3 are trading sessions, Monday, Tuesday, Wednesday. On Tuesdays, we have Kickstart classes, and on Thursdays, we have live Q's and A's, questions and answers. Every checklist and manual has a how-to video, so you can see it, you can read it, or you can watch it. And of course, you get your Kickstart classes and recording of your Kickstart classes. I have just a few moments, so we'll just get right into it. The next live class is March the 12th, 2021. And we're going to have the deal of the day with a couple of reasons, because number one, we're on InvestorExpos, and we always enjoy being on here, so we like to provide the best opportunities whenever we're here. Second thing is we also want to incentivize you to take action to join us for the March 12th live class. So we do have limited spots available. Traditionally, how the program works is the enrollment is $3,594 for 12 months access. And you may say that's a lot of money, and we agree with you. But when you put your investment caps on, you look at this as an investment return on the investment, the last 11 calendar months has averaged over $10,000 US a month utilizing the strategy, trading up to 3 E-mini contracts. So most people will be pretty happy with the return on the investment opportunity. Today, we're providing a member-only savings, so a one-time simple easy payment of $14.97. Traditionally, it's just for 12 months access. Today, we're going to give it unlimited access. So it's unlimited access for the life of the program. So a one-time simple easy payment, $14.97. Unlimited access life of the program. Unlimited means unlimited. You get unlimited access to the indicator, the strategy, the self-directed automation, the technology, the checklist, the manuals, the live classes, the customer support. You get it all. No maintenance fees, no hidden charges, one-time simple easy payment, $14.97. For those of you that wish to enroll, you can go to destinationtrader.com. So here is the link in the question section box for those of you who would like to enroll. For those of you that have questions, what you can do is type in your name and your telephone number into the question section box. But if you go to destinationtrader.com, this will give you the ability to enroll online. It is limited seatings. And what you can see, you can get started with American Express, MasterCard, Discover, Visa, or PayPal. First name, last name, email address, phone number. Name on card, credit card number, expiration date, CVV code, complete your purchase, and you are done. You do receive a 60-day, 100% money-back guarantee. You also receive a white glove installation to where if you wish, our team will be more than happy to remote into your computer with your permission, and we can download, upload your softwares. Just understand we're not CTAs or money managers, so we can't pick your entry settings. You also receive 36 live online trading sessions. For those of you who would like to speak to one of our team members, you can always contact us at 1-888-483-5161. You can also type in your name and telephone number in the question section box. We'll be very happy to have one of our team members contact you. I want to give a big thank you to InvestorExpos for having us on. I want to say thank you so much for Anna for being our host and giving us the opportunity to educate everyone. I just want to congratulate Peter. Peter, we do have your telephone number in the question section box. We'll be very happy to reach out to you. Terrence, we have your telephone number. We'll be very happy to reach out to you as well. All right, everyone, have a wonderful day. And on that note, every day, helping people find a way. This is Joshua Martinez.
So thanks again for attending, and thanks again for hosting this, Anna. It's great to have all these people that are obviously very interested in learning new trading styles. One of the things that I think was just kind of time appropriate for me was how to buy the dip. Since we've gotten the dip, it's not a major correction yet, but we've started to see some weakness in the markets. And for those looking for a way to buy the dip, especially using the leverage and defined risk of options, I wanted to get that this set up for today. So first things first, if you have questions, feel free to throw them into either the chat box or the Q&A box, and I will do my best to answer as we go through. As I'm sure you've all seen, I got to do my disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through this while I take a quick sip of coffee, and then we will get into the good stuff. All right. So with that in mind, I like throwing my picture up here for those of you that are not familiar with me. I've done a few of these presentations with InvestorExpos. You may have seen me in some of my other presentations with other places, including at our home site at optionhotline.com. I started my career in the option pits of the CBOE back in 2005. So really, I guess, earned my stripes by trading through the subprime crisis as an options market maker. So it was a crazy time. Stocks went absolutely nuts. For those of you that follow the VIX, it exploded. And of course, it was a time where options really became a major focus for a lot of investors, realizing that benefit of using them for hedging strategies to find risk. And also those that got burned by putting too much capital into individual options trades, particularly when the market hit lows. If people were buying puts at that point, just naked, it was a very painful time for them. As the market recovered, markets tended to tighten up a lot. We switched to a lot more electronic trading. What that did is it made markets, instead of being a nickel, a dime, 15 cents wide, not necessarily great for the retail trader. A lot of markets now are about a penny or 2 cents wide. Really good for the retail investor. Not so good for the market maker because the margin goes away. The market maker's job is to effectively be there to buy the bid and sell the ask. When there's a lot of volume and markets are wide, that's great. When there's a lot of volume and markets are tight, it's okay. When there's low volume and markets are tight, it's not so great. Coming out of the subprime crisis, the market got really tight and volume started to come down a little bit as well because it wasn't quite as exciting of a time with the VIX dropping back down towards more normal levels. It made me realize that I needed to get a better edge on options, really understand more of the second order and third order derivatives, the skew and everything else like that. Got my MBA from the University of Chicago with honors, decided to go work for a hedge fund. Now, the idea here was that by going to a hedge fund, and in this case it was a CTA, which is generally a commodity trading advisor, so they're generally technical focused, I could combine technicals on the market with my knowledge of options to try to structure trades that basically optimally perform given the technical or fundamental view of where the stock, or future in our case, was going. Working for a hedge fund was fun on its own right, but I prefer working with individuals. I've been teaching people how to trade since I really started in this industry. I was always teaching the junior traders. I was teaching at the hedge fund how to use options while they were teaching me how to do technicals, and decided I would rather be on the teaching side, the educational side. So I started Trade Academy in 2017. I joined Option Hotline as the chief option strategist in 2018 to provide this kind of content to people like yourselves. If you have to leave early, because I know some people get busy during the day, maybe something comes up, a work call, a kid, any of this stuff can happen. Do me a favor. Email me, keith@optionhotline.com. This is my personal cell phone number. So not a lot of people like to give out their phone numbers, but because I like the market so much and because I like working with people so much, I'm just going to give it to you now. Please do that. Call me, 312-600-8004, if you have questions that we do not address in the presentation today. And don't also forget to keep an eye out in your email, webinars@optionhotline.com. I'm going to send you the trade checklist that I actually use for structuring my options trades. So that's free. So I want you to make sure you get that. What we're actually going to discuss today is what are the current market trends? Which dip do I prefer to buy, because not all dips are equal? Why I use options, that goes back to the core of why I started in this industry. In particular, why volatility matters and how I structure an option. And then the two ways that I buy the dip with options. So for those of you looking for shorter term trades or swing trades, that's one way I can buy the dip with options. For those of you looking for long-term holds, I can create a trending portfolio buying the dip with options. And that's what I do. I mean, I've got two different strategies, mostly on the short term and the long term, and I utilize options for both of them, just in very different ways. So let's look at the market. This was from the close yesterday. The markets are obviously down a bit today and actually dropping as we speak. The tech sector in particular is starting to get weak. Right now, I see the S&P 500 down about 1.36%, tech's down 2.2%, and small caps down 1.95%. So we're getting a little weaker here. But after the close yesterday, we were back above some of my key moving averages. Those that are not familiar with my charts, the five things I really want you to focus on here today are the moving averages. Purple is the 10-day moving average, green is the 20-day moving average, blue is the 50-day moving average, yellow is the 100-day moving average, and red is the 200-day moving average. The reason I highlight those is because moving averages tend to be a key input for trend traders. When the stock price is above the key moving averages, it tells you that that period holder is making money, because you take the average closing price over, say, 10 days for the 10-day moving average. If the stock price is above that, anybody that has been buying the close every day for the last 10 days is actually making money and feels pretty confident. That's why moving averages tend to be meaningful. Those guys that have been buying for the last 10 trading days, 2 weeks, if the stock market starts to fall below, they start to see a little bit of red on their ledger and they get a little nervous. If you get below the 20-day moving average, those guys that have been buying for the last month get a little nervous. 50-day moving average, we're over 2 months now, people start to get real nervous. So, back when the GameStop craziness happened, we started testing some potential major liquidation, but because of the way the market functions and the way that this was really built off of people just closing positions because of a short squeeze, there were some decent reasons to be confident that that was a decent dip to buy. This one, we're going to have to see how it goes. I'm not so sure yet. S&P 500 still looks okay, being above the 10-day moving average as of yesterday's close. Today, we're back below. When I go to tech, it's much worse. So you can see that in tech, we are below the 10-day moving average, the 20-day moving average, and yesterday we tried to breach the 50-day moving average, which has held since the election. So we haven't been below the 50-day moving average in tech since the election. That is a big level. That could create some serious panic if we can get below and hold below. That creates concern for me. So this is something that I am very nervous about on this market. If it goes back below, say today, after trying to recover the 50-day moving average, I think there could be some major position liquidation. So tech is not a sector I'm necessarily looking to buy. Small caps have skyrocketed since not just the election, but also the announcement of the first COVID vaccine on November 9th. Small caps tend to have a lot of focus on sectors like oil, financials, even retail, all these sectors that had kind of gotten forgotten over the prior 4 years. Oil prices are up from 40 to 60. Financials are doing better with bond yields rising. Businesses can reopen. People like small caps right now. So this is the really strongest trend in the market. I mentioned the simple moving averages. I just want to put the words out here right now for those that didn't take the notes quick enough. Simple moving averages take the average closing price over a recent period. The 10, 20, 50, 100, and 200-day simple moving averages are common examples. They are generally meaningless at the high level. 10-day moving average makes sense. That's 2 trading weeks. 20-day moving average makes sense. That's basically a month of trade. 50-day moving average, it starts to get a little hairy. It's 2 months plus a week. 100-day moving average, it's, I guess, 4.5 months. The 200-day moving average is 9 months. I'd prefer traditionally to have said 2 weeks, a month, maybe 3 months, 6 months, and a year. But these were the ones that everybody looked at. And so these are the ones that I have to look at, because if computer programs and people look at the numbers and everybody's looking at the same numbers, those tend to be the numbers that work. Self-fulfilling prophecy. Okay. So we use that self-fulfilling prophecy to make our decisions here on a lot of this stuff. Trend traders like to be long above the key moving average and short or out below the key moving average. So I'm going to draw on a trend channel here overall, just to give you guys another perspective on this and why I can get nervous on tech and not maybe yet on S&Ps or small caps. A trend channel is basically, it shows you the momentum. So you can see it's up in the S&P 500. It's going smoothly. We tested below the trend channel a little bit right at that GameStop short, crazy Reddit trade thing. We tried to test below it yesterday. It didn't really hold. And right now, if one were to look for a dip to buy, buying near the low of a trend channel and selling near the high isn't a bad strategy. You just basically take the money as it goes. Note that though the high end of the trend is always rising, so you don't even necessarily need to sell at the high. That's just for short-term profit taking. In tech, the trend is breaking, especially today. Now, if today we had recovered this trend channel, I would tell you that probably everything's rosy and everything looks good, but tech is falling again today, meaning that it's not holding the trend channel and it's starting to give me concern on the markets. So this is not a dip I want to buy in tech. In small caps, we see that massive slope, great return overall. It's been a really, really big winner for 3 months now plus. You know, there's justification for profit taking when you get into an index in the range of, say, what, $170, and it's already up to 230-ish. So $60, which is about, what, 40%, just about in a matter of 3 months. That's an insane return, especially in an index. So I can see the fundamental reason to be bearish or out of this market, but while this trend channel is holding, it's hard to fight it. You know, you could have said that this trend channel looked like it wanted to break back in January at prices just under $200 in IWM, and now we're, you know, 230. So we've gotten 15% in 2 months, less than 2 months. I mean, that tells you the power of these trends. And at some time you just got to go with the flow and let it work, but also practice risk management. That's why I incorporate options, is to practice risk management. So to reiterate, what am I looking for? Which dip do I prefer to buy? The one in S&P and IWM where we're in the trend channel? I say yes. Below the trend channel, like in the tech sector? Absolutely not. So I want to find where the momentum is going and stay with it. That's why right now for me, buying into tech is a bit of a dangerous game. You're starting to test into that idea of catching a falling knife, which a lot of people will talk about. It really means what you're doing is you're seeing the drop and just saying, I know the value of tech. Well, nobody knows the value of tech, because at the end of the day, computer trading algorithms tend to push markets below value, and that's where you want to be getting long when everybody else is investing, because they're providing the floor. I can't provide the floor. I don't have enough capital. You need a lot more money than probably anybody in here has to provide a floor to the market. Now we can help push everything back up by investing when everybody else is investing, but we can't stop a fall. So I'm nervous about tech. I'm less nervous about small caps and S&Ps, but I'm starting to get closer to being nervous because they're looking like they may not hold the trend channel. We're going to watch out for the next few days. But testing the low end of the trend channel, not a bad thing. It gives us a good entry point. Below the trend channel is a bad thing. It gives us a bad entry point. Before we go to the next thing, I just want to let you guys know. So for those that have to jump off early, I do an outlier watch list. This is exactly what I put on it. I put in names. It's all from, actually, this is all from the NASDAQ, but the trend trading candidates that we are invested in right now have an average 160 profit on open trades. These are longer term holds. Swing trading, our average is 204% profit on winning trades. If you're interested, go to optionhotline.com/outlier. It's actually a very cheap watch list. It's only $97 a quarter. I just want to get you guys out there on that in case you are interested already. Go to optionhotline.com/outlier to take a look. Now, let's talk options. A question about fallout from the bonds. I think fallout from the bonds falling is two things before I get into the options. Number one, it provides potential for real yield from portfolio reallocation, which could create some rotation, i.e., if I can get a real yield from fixed income, I want to allocate a little bit more of my portfolio to that safety net. At the same time, increasing yields tends to be positive for the financial sector, which can be positive for small caps. So we may not necessarily immediately see the small caps continue higher with bond yields rising, but remember a couple years ago when bond yields started to rise, that created a market liquidation event because everybody thought that if the long-term interest rate was over 3%, I believe it was, that would create a major trigger for portfolio reallocation. And because everybody thought 3% was the number, 3% became the number, everybody did it, crash, and then you rally out of it. So I don't necessarily want to be long during the crash, but I love finding opportunities to buy after the crash. All right, so options do have an incremental risk over stock that have to be pointed out here, and I always just try to make sure that everybody understands this, because for those of you that have been trading or are thinking about trading, risk management is, I think, the primary skill that has to be understood. So we all like leverage. We all look forward to leverage, but risk management is the thing that keeps us solvent every day. So markets can trade irrationally for longer than most people can stay solvent, but if you practice good risk management, then you can outlast those irrational days and stay solvent and stay in the game. Part of that risk management is understanding that transaction costs exist as well as assignment risks, as well as options decay and options volatility. So transaction costs are higher in options, partially because they're riskier. So they try to create a little bit of a barrier to entry into options. Brokerage firms have also gotten to the point where stock is effectively free to trade. There's just other ways that they make their money off of it as opposed to charging a commission to the customer. Assignment risk, if you're trading short options, is a big risk. I don't use outright short options in most of my programs because they create potential risk for margin, where you could lose 100% of your account or even more and owe your brokerage firm money. That's not a good situation to be in. We don't want to take that risk. I'd rather have defined risk, know exactly how much I could lose, even in the worst case scenario where stock goes all the way to zero because it turns out they had accounting problems. Options do decay in value over time, so if I'm buying options, they become worth a little less every day. Think of it like an insurance contract. If I'm betting on myself getting injured in the next year, well, every day that passes that I don't get injured, I would pay less for that, because if it's just for calendar year 2021 and it's December 30th, I have one day to get injured to cash in on this insurance contract, versus if it's on January 1st, I have a feeling I might get injured this year. Who knows? I'm a little bit accident prone at times. Of course, volatility is the other one. Implied volatility rises and falls every day. This is what market makers in the options market are trading off of. This is what proprietary traders in the options market tend to be trading on, is the rise and fall of volatility, best illustrated by the VIX. And that can create major profit and loss movement. And we'll talk a little bit more about that volatility in a few slides. So for those of you familiar with options, this may feel a little like a recap, but it may also provide a different perspective on how I view options and how I like to think of them. Okay, so I still urge everybody to look kind of follow along here and think about how options work for you. This is going to be a simple exercise on stock versus options. If I have a stock that's trading $100 and I have a $10,000 account and I'm putting it all into the stock, I can buy 100 shares. Now, if I think this stock is going to rise 20% over the next month, that's a pretty darn good return. And I can make $2,000 on my $10,000 investment. That's good. My targeted max loss, maybe I say that if the stock goes below $90, it proves me wrong. I don't want to lose more than $1,000. So if it goes to 90, I just get out and I start again. Stop losses are risk management. This is what keeps us solvent, as we talked about before. But at the same point, if I go to sleep tonight and then I wake up and my theoretical stock here turns out to have been a sham, and now it's trading $20 a share or $30 a share, you get it all the time with like biotechs. They have an FDA announcement. Turns out, this is not a sham situation. It just turns out the FDA rejects their drug. The stock can cut in half or more overnight. I don't want to take that risk in stock because I think I have an exit and then the market doesn't provide it to me. Because if the stock tomorrow morning is trading $20, I can't get out at 90. I'm probably never going to get out at 90. I have to take an 80% loss, an $8,000 loss, and that sucks. But if I can trade an option, for example, a call option for $5 per contract to give me the right but not the obligation to buy the stock for $100. Now, this creates a different risk-reward scenario. Now, because I'm paying $5 of premium, I need the stock to rally to $105 to break even instead of just not moving. Okay? Now, if I buy 2 of these calls, I now represent 200 shares in the market instead of 100. And if I buy 2 of these calls, I spent a total of $1,000. I didn't spend $10,000. I have $9,000 of cash in my portfolio. What I want to do with that is up to me, how I want to manage my portfolio, whether I want to stay in cash with it or allocate it to other trades. But right now, if I buy 2 of these calls, I've spent $1,000. My max loss is $1,000, whether the stock goes to 90 or 20 or 0. The problem is if the stock doesn't move at all for the next month and just sits at $100, I still lose $1,000. The good thing is if I was right about my thesis and the stock goes to $120, my profit's now $3,000 instead of $2,000. And if the stock goes even higher, you can start to see those exponential return parameters. So it's much, much more profitable on the way upside, much, much less damaging on the downside, way downside, and somewhere in between, in this little triangle, stock was better. So between $90 and $110, I would have rather been in stock. Above, the option's better. Below, the option's better. You start to see the trade-off. Options give us leverage and defined risk in exchange for that option decay, which you're capturing right here. So if the stock rallies from $100 to $102, I'm still going to end up exercising my option or selling it out for $2, but I lost money. So even though the stock was up 2%, I didn't do so hot. But if the stock is up 20% like I was theorizing it could, I did 50% better than a stock position. That's pretty good. So it's all about the confidence in the thesis, understanding the technicals, and understanding how I can pair these options with technicals. Because if I start theorizing that this option, the stock is going to go up 3 to 5% next month, I don't need options for it. It's not going to give me the leverage. Defined risk means nothing if I'm not even getting leverage on top of it. I'm walking away. This is why volatility matters. That call option priced at $5 may be too high, too low, or somewhere fair. So let's assume that my options analysis tells me that $5 is the fair value of that $100 call. And then I look at the marketplace and they're saying, well, you can buy it today for $4.20 because implied volatility, that volatility level, the parameter that we're putting into the model that says that we think the stock's going to move less, or other people say the stock's going to move less, means that these calls are priced at $4.20. Now I'm getting a 17% discount on my value. This is where I get sale. I'm buying an option on sale, I get more leverage. When I see an option on sale, I don't want to buy the at the money call, I want to buy leveraged calls. If I have a combined knowledge of where I think this stock is going with a reasonable percent probability, plus I get low implied volatility, I can buy options on sale for $106 call, which means the stock has to go all the way to $107.97 for me to break even. But once it gets above that, I get huge leverage because I'm buying these calls for a 28% sale from fair value. And if we had expensive options, which I don't want to buy, it's about a 60% discount from that. This is what I want to find. I want to find cheap options when I'm swing trading. The VIX right now is fair to cheap in spite of the fact that the market's falling a little bit. This means I like at the money or out of the money options. And you can see a visual representation of why. Here is those cheap options. Here are the expensive options. We'll just zoom in rather than trying to focus on it here. When you see cheap options, out of the money calls tend to give you all that leverage. We talked about the upside from the $100 call in red here. So that was a $3,000 payoff if I hit my target of a 20% move. If I could get the $106 calls and spend the same amount of cash, now I'm not buying 2, I'm buying 5. So when we get up to $120, I'm not making $3,000, I'm making $6,000. You see that big return from leverage. Options are all about leverage and defined risk and finding when they are priced wrong. So for me, I like buying out of the money options when volatility is too cheap. When volatility is too expensive or even too cheap, an in the money call option acts a lot like stock. This is why a lot of people will promote always just buying in the money calls. Why? It acts like stock. They don't have to have as much of a cushion on their volatility risk that they are looking for. So even if implied volatility is cheap, it acts a lot like stock, just a little bit better. Now, when implied volatility is expensive, it acts a lot like stock, just a little bit worse. But when implied volatility is expensive, you get much more risk out of those out-of-the-money options. So you can see there's this huge payoff potential for out-of-the-money options when implied volatility is low, or even at-the-money options when implied volatility is low. But when implied volatility gets high, there's really no reason to do anything other than buy stock or in the money calls and just do a stock replacement strategy because you're not getting that leverage to the upside. This is what I try to avoid. So when implied volatility is high, I'm not buying out of the money options. When implied volatility is low, that's exactly what I'm looking to buy. There's a question, what deltas do I look to buy? You are one slide too early. When I'm trading a trending market, so just trying to take a longer term view, I find a long entry that's in that bottom portion of the trend channel. So not below it like we are in tech, but in it still, like we maybe see in small caps or S&Ps. I'm a little more confident on S&Ps just because we haven't had that magnitude of move in small cap that we had in small caps. And I structure my trade with 3 to 5 months to expiration, 65 to 80 delta options. This is effectively a stock replacement strategy. There will be some implied volatility risk, but not as much. Why is there not as much? Because we have more what's called intrinsic value. It's how far the option's in the money. So that $94 call with a stock trading $100, it's $6 in the money. It means that even if the stock doesn't move, it's worth $6. The $100 call, stock doesn't move, it's worth $0. The $106 call, if stock's up $3, it's still worth $0. So the intrinsic value helps in a trending market. Why? Because we're not looking for that explosive move of 20%. I'm basically doing a stock replacement strategy so I can leverage my portfolio by allocating capital to other trades still. Instead of putting all of my money into the one trade for $10,000, I've got my defined risk to the downside just in case, and I can go look for a couple of other trades. I'll probably still keep some cash on the sidelines just in case. We don't want to be always 100% invested long in the market. But if I can put a little bit here, a little bit there, find 4, 5, 6, 7 trades, and have some cash on the sidelines, I've now got a leveraged portfolio to the upside with defined risk, even though I'm trading stock replacement strategies. It gives me that momentum for the trend, taking that percentage return we're normally getting in the trend, and I can kind of predict how much percent we're going to get in the next 3 to 5 months if I just follow the midpoint of that trend channel. So that's how I try to analyze whether it's a good investment or not. Because if we're going to stay in the midpoint of that trend channel for 4 months, well, now I can predict where we're going. And now I can know whether or not the options are priced appropriately. Now, for swing trades, it's a little different story. I'm looking for a shorter term move, maybe back to the upper section of the trend. If I'm not just predicting the direction, but also where the stock will find new resistance and could stall, such as a recent high, I can pinpoint my trade. So if I'm worried that we're not going to actually continue the trend, but we're actually going to recover from the current dip and then stop at the highs for a little bit to consolidate and figure out the next move, this is a great time for swing trades. So that's where I switch my concept and say, okay, I want to focus on short-term trading by taking advantage of shorter-term options. So I want my stock price to go through or away from my long strike and stop at my short strike. That's the goal of any debit spread. So a debit spread is where you take a simultaneous long position in one strike of call and a short position in a higher strike call with the same expiration date. There are other strategies that are more complicated. Happy to talk about them offline. If people want to email me or call me, we can talk about them further. But today I'm going to focus on just a simple debit spread. The idea is here, if I think that Qs are going to go back to their previous high, then I don't want to buy that far out of the money call. So the previous high was on February 16th. The high made was $338.19. I don't need to buy like a 330 or 335 call because we're just not going to make any money on that. So if the prior high is 338, maybe I want to sell a $338 or $340 call saying it's not going to go through that. So that's where you get this structure. Let's pretend in my $100 stock that the previous high was $106. Well, then if I think we're going to stall there, the $106 call has very little value to me, even though technically for the options market maker and everybody else, it has some value because there's a potential for it to spike through. For me, if my thesis is that we're going to go from a current price of, say, $98 all the way up to $106 and then stop, well, I think there's more money to be made buying a call spread, the debit spread here, than buying the outright call. Let's do our comparison as always. So if I'm buying the call, I don't make money until we're above $105 because remember, this was a $5 call. So if I think we're going to 106 and that's the ultimate upside, all I'm saying is that I'm risking $5 to make $1. It's a bad trade because I'm risking 100% to make 20%. So unless I'm really, really good at my prediction on probability, this is probably not going to be good. If I was going to get out anyway, once we get to $106, I don't have that unlimited upside, because if we go to 107, but I sold once we hit 106, my unlimited upside is gone. There is nothing there. So why would I swing trade expecting a move to 106, planning to get out at 106 by buying the $100 call? It's not a good trade. Worse would be buying the $106 call. Better would be buying the call spread, buying the $100 call and selling the $106 call, doing it in an equal dollar amount, risking my $1,000. Now, my break even was $102.30, because that's what I was saying that the debit would be for that call spread. And if we get to $106 as planned and stop there, it's worth $6. So now I'm risking $2.30 to make $3.70. That's a much better trade than risking $5 to make $1. I have a greater than 100% return instead of a 20% return. So even if I'm wrong 50% of the time, I'm making money in the call spread. If I'm wrong 50% of the time, I'm losing money in my call trades. This is why call spreads can be crucial when we're buying a dip as a swing trade. 1 month move, 6%, great return. But you got to be right a heck of a lot more often than wrong, buying it out and in the money or at the money call in this scenario. And that's just not all that feasible. So if I can create a scenario where the odds are in my favor, that's better. So here's a recap of the general trade idea. And again, this is the delta question that TJ had. I'm looking for a setup with a stock that's in an uptrend that's falling lightly. Now, if it's the Qs, we're out of that trend channel. We're below it right now. So what I want to wait for is a recovery of the lower part of the trend channel for me to get in. Even S&Ps and small caps today look like they may fall through that trend channel. So I'm not doing the swing trade today. I'm waiting for us to get back to the lower part, much like I'm doing in a trend trading system. But if I'm thinking that the trend will stall, a swing trade makes more sense to me. If I think the trend will continue, a trend trade makes more sense to me. It's all about the term and the leverage I can get. So with about a month to expiration options, I can buy a long call that's roughly at the money, maybe slightly out of the money, and I sell a call further away above that resistance point, like above the previous high. So if it was the Qs, where the previous high, as I said, was, what was it, 338, I might be selling a $340 call. That way, we don't quite get to my short strike. That's not a bad thing. Going through the short strike isn't perfect, so going just shy of it is absolutely perfect. Going right at it is the 100%, the holy grail. But if we can get close to it, that's really good to me. So, if I was structuring today in the Qs, I might be buying a $317 or $320 call, something in that range, and selling a $340 call. It's just that simple. Creates leverage and allows me to play for the bounce back in the markets without risking everything. Now, again, I'm not looking to buy that today because we're not back in the trend channel, but that's how I would be doing it if this were the price of the lower end of the trend channel. So now what I want to do is take a little time for Q&A. I think we have about 10 minutes, and I know some questions always pop up as we talk about this sort of stuff. And I want to know how I can work for you. So if you have questions and you want help planting the seeds to becoming a winning trader, the first thing that I can do for you, and this is the cheapest entry point we've really got, this is the Outlier Watch List. It's weekly. So every week I send out my swing trading ideas that are on my short list, like 5 ideas that I'm looking at to swing trade with the price trigger, with a general sense of the call or put structure. I also send you a list of the names in the NASDAQ 100 that I am looking at to enter as a trend trade. These are long-term holding positions. They have really good potential, and obviously you can see the average profit on these open trades, that these are options profits, are 160%. One of our trend trading portfolios last year, I think, was up 145% for the year. These are good numbers, I think. So I'd like to talk to you guys more about these. If you start here, you have questions, obviously always free to email me, keith@optionhotline.com, or call me. Now with that, let's go through a couple of the questions here as they're popping up. Is the tech market going to crater? I don't know, but right now it doesn't look good. So for me, seeing this tech market starting to fall and getting below some of these key moving averages and below the trend channel creates some real concern. So I'm very nervous about tech and the potential that tech could drag down the rest of the market. But if I start seeing tech start to find some support, particularly semiconductors, then I can get a little more confident actually in investing in small caps and S&Ps. So as weird as it seems, I'm waiting for tech and semiconductors to stop falling to invest in the other sectors. Because at some point, the tech sector is going to drag everything down since it's been that leader for so long. Day trading options. So with the programs that I'm doing here, I don't focus on day trading. They're shorter term holding periods in the swing trades. They can be as little as like 2 or 3 days. Part of the reason I don't like to day trade the options is because I send out ideas, of what I'm looking at for a swing trade. And if you're not glued to your screen, it may show up an hour late for you. Now, getting an idea an hour late could be the difference between a winner and a loser, or I might already be out of the position, and it's hard for a lot of people to spend that much time glued to the screens. Those that are interested in day trading, I do provide mentoring services to talk about how I have day trade. I mean, I used to, as a market maker, I was trading 20 or 30,000 contracts a day. So just to give you some scale on it. So that was definitely a focus of mine prior to my time at the hedge fund and now as the educational stuff, but I do tend to move away from that in terms of trading programs. Am I the only coach at Option Hotline? No, we have a number of mentors tied in. If you go to optionhotline.com, you can see a list of who we've got that are providing content under the, I believe it's authors tab. So we've got a number of people tied in that I'm sure you're all familiar with. And if my style of trading doesn't necessarily fit what you're looking for, I'm sure we've got somebody that can fit your style of trading. So again, optionhotline.com/outlier is where you get that outlier watch list. Again, it's only $97 for a quarter, so it's about $1 a day. Skip a few Starbucks runs and it pays for itself already. I've had a number of people that have been telling me the last week or so, because I had a bunch of put trades that we were looking at over the weekend, that it's already paid for itself many times over. So, for those of you looking for just sort of an entry point there, feel free to do that. We do have other programs, the actual trend trading program and the swing trading program, that are also available for annual or monthly subscriptions. So take a look at those under my name. Now, is the phone the best way to reach me during market hours? For me, email is usually the best, but I'm happy to answer a call during market hours. I will do my best to take the call. Sometimes I'm already on a call, so if you miss me by phone, throw me an email and then I can call you back. We can schedule a time to have a call. A lot of people don't like to make themselves available like that, but I'm happy to do so. Do I take other spreads? Absolutely. Lots of different spread trade options as you go through trades. So calendars, diagonals, all of these things have a role in a portfolio. For me, I tend to avoid credit spreads just because I think people tend to over leverage them. And I just personally, I just don't like getting into that oversized credit spread to try to squeak out some nickels in front of a steamroller. So selling a put spread right now in the Qs just wouldn't necessarily fit for me, because your risk reward profile, you're potentially risking $5 to make one. And now you can structure that call trade, like I said, where you're risking $5 to make one, but I can structure a call spread trade where it's got a greater reward than the risk. Condors, I like condors, but I don't have any programs or anything that I do right now with condors. I've been focusing on call spreads and call diagonals, and put spreads and put diagonals as well. But for our trend trading portfolio, I think for those of you that were on the previous presentation, he talked about long only. For our trend trading portfolio, we focus long only because of the fact that money flow does still tend to go into the market. 401k investments, everything else, money has to go somewhere. For swing trades, right now I only have short positions because of what I'm seeing in the tech market. I'm probably going to keep it that way for a little longer. And for our trend trading portfolio, I just lightened up a lot of our long positions and went heavily into cash to define our risk that much more. It looks like that may be the extent of the questions for the moment. Are there any other questions before we maybe take a short break before the next presentation? Well, if anything pops into your mind and you want to talk more, you got my contact information right there. Keith@optionhotline.com, the phone number. I do urge you to check out the Outlier watch list. It's a cheap entry point into getting some really interesting trade ideas real quick. And then if you have questions about those ideas as you're looking at them, you can always reach out to me because I try to make myself as available as possible. Last thing I want to see you guys do is trading with a lack of information. Thanks again to all, and I hope you all have a great rest of your trading week. Keep an eye on that tech market because it's looking a little bit scary again today.
What's up, everybody? Welcome aboard, and it's always great to hang out with people during the day and talk about what we do. And we have what we call an equity management program through our proprietary algorithms, and it's basically a trend trading system, okay, that is in a number of different markets, and we are always in the market, either long or short. We are never out, and the portfolio that I use is in 23 different stocks every single day of the year, every year, forever. And the only thing we do is if we have to reverse. Now, we don't trade actively because typically trends will extend, but we're using our algorithms, and we're using straight mechanical trading. There is no decision making to be done. It's just simply set them, put them on, and we only trade once a day, if at all, and that is you get your orders in the morning, well before the market's open. And we do have one new feature too, which I'll show you, which we now have. Depending if you're using our preferred broker, you could have auto trading as well, and it'll trade for you automatically. But in the meantime, we like to share with you all the things we do. And of course, first, before that, I have to actually show you the disclaimer. Okay, and of course, you've seen this already a couple of times, and Keith did a great job with his options. But this is just a general disclaimer that nothing is guaranteed. And in fact, I will not project any forward results. I'll show you all the past you want because we have all live trades. But I always like to share a couple of thoughts from users that have been with me for a number of years, and I want to thank you for sharing what I consider to be the closest thing to the holy grail in investing. I've spent countless thousands on investment subscriptions that helped me become financially literate, but when it comes to making money on investments, luck kept entering into the equation. Profits came and went. I kept running into the brick wall until I found you. As an engineer, I've always looked for a method of investing that was mathematical and statistical certainty. Your strategy does. I cannot thank you enough, and look forward to following the markets for many years. And of course, this is what we do. But before anything else, okay, remember, okay, if you're in the trading market, if you are trying to trade, okay, there are going to be drawdowns. Drawdowns are a natural part of trading. Okay, if you think they're not, there is no magic. There's no magic world out there. That you're always going to have experienced drawdowns, and you'll see. I will actually share with you our equity curve so you can see, when we've had drawdowns and what we've done. We've always gone on to make new equity highs. But at the end of the day, be prepared for the risk, because that's always going to be a part of the game, no matter what you're trading, no matter what you're investing, or no matter what you're dealing with. Anytime you are looking for a way to make money and leverage up your money, which is what we're going to teach you today, you're going to have exposure, but you will know what that exposure is exactly. And of course, if you have enough margin money to cover the leverage, you'll never have to worry, because we've never had, on the proper amount of leverage, a margin call in any of our accounts ever. So In the meantime, remember this is part of the business. Drawdowns happen. You can't stop them. You can't avoid them. It's just like we're not like the Federal Reserve, who's trying to avoid recessions by printing money. We print money our own way, which is by earning it and continuing to put it back in. So, in the meantime, remember that, and don't think there's a magic world out there. Okay. Now, if you can follow rules, and some can, some can't. I mean, it's that simple. Okay. Mechanical trading, the rules are cast in stone. There's no room for instincts. Okay. Not one trade ever leaves my office that is from my opinion. I've got opinions. If you've ever seen me in the media, you know I've got an opinion, but I am never going to, trade against what the algorithms tell me to do, because they are searching for the trend, and they will find the trend at all times. All we're trying to collect and make is always the meat out of every move. We will never sell tops. We will never buy bottoms. We are simply in it to win it, and in it to catch the biggest portion of the move. But the rules will take care of your mental side if you can follow rules, okay? And we don't modify any trades. They are what they are. That's what we make, okay? Now, I always like to ask people, what are your goals? Okay, why are you here, and what are your objectives? Okay, which is, we're all here to make money, and that's what we try to do. Okay, is to make money. But do you want to make money, or do you want to be right? And that's always a big question in this industry, because amateur traders want to be right. Professionals want to make money. Now, I've been a professional for quite a while. In fact, this is my 43rd year as a member of one of the Chicago exchanges. I am still a member of the Chicago Board of Trade now, which is actually the Mercantile Exchange, but I still go by the Board of Trade. I did start my career at the CBOE, okay, in 1980, and a little bit before that. But in the meantime, I've done some financial commentary. I still do. But the key I always like to talk about is every recommendation that I make, I also trade myself. Okay. So everything that leaves this office, I am involved. You can bet on it. You can see it. Okay. And I always share it with you. But that is, again, I'm a big believer in what I do. If I don't like it, I wouldn't send it out. Okay. Now, algorithmic trading is, it's part of mechanically based. And if you remember the turtles, okay, or you go back to those days, I was very friendly with Richard Dennis. He traded at the CBOE for a while, and him and I were very friendly. And, again, when he started this thing, he said that I could take anybody from anywhere as long as they can follow the rules, okay, they can make money. And, of course, that is factual. He proved it, and it can be done, because markets themselves don't really matter. I could know the trade without knowing the name of the market. That is a fact, okay? Because when you're looking at markets, all charts are the same, okay? It's the patterns, and it's the pattern recognition that you're looking after, okay? And, of course, that is what the algorithm is doing. The mechanical part is simply taking all the rules of trading, but deciphering and taking out all the news. We as people have emotions. We get involved with the news. The news, you trade the news, you lose, okay? You have to just learn to be a straight robot, okay? And even if you're trading yourself, and even if you don't become a member of mine, just remember that all charts are the same and all patterns repeat themselves. The only thing that changes is the time frame in which you're trading, okay? So, we all hear the stories. There's no such thing as a secret indicator, okay? Again, 43 years, I can tell you there is no magic in this industry. The magic is find a system that works, stick to it religiously, and don't change, okay? That is the way to make money, is because the biggest thing you'll see, and I'll show this to you a little later, but how to establish what your win rate is, and then it'll help you trade better with knowing your win rate. But if you just follow rules, again, we have this conversation a lot. Watch your capital and follow the rules, and you will always be in good shape. And more importantly, you will always be in the game. Okay, and that's the key. Inventory is the key. Okay, and I think this is something that many of us may or may not recognize, but we are our own worst enemy. Human emotion, human natures is our own worst enemy, okay? That is where we make those bad decisions that we should not be making, but typically it will get caught up in your emotion. And so when everything goes really bad, I just say, go look in the mirror, make sure you weren't taking care of it yourself, because that happens more often than not as we get too emotional about something versus letting the systems, letting the markets do the work for you. Now, why algorithmic trading? Success or failure, family office, creating synthetic stock, shorting stock, profit factors, portfolios, and how you can take advantage. And of course, I'll always answer any question you have about any form of trading. I've traded every market, including the weather. Okay, so I've traded every pit that there is, and I can help you and answer any question. We'll be happy to do so. Why do professional traders use rule-based trading systems? Okay, because everything becomes automatic, because then it leaves no subjectivity to your decision making. Okay, there's no hunch trading. There's no, I think, I heard on the news. It is straight by the rules, by the book, because again, you have to take out all the factors that can create bad trades for you, or what we call heartburn trades. Okay, because the bottom line is that price action tells you what the market's going to do long before any news will ever show up anyways. That is why the efficiency of the market now, especially now, when I first started, we didn't have the kind of efficiency in markets. They weren't open 24 hours a day, basically. We had, in my first clearing firm, there was 48 traders. We had two little 12-inch LED screens. We didn't have iPhones. There weren't even car phones yet. Okay, so again, you use rule-based because you want to take out every bit of information, because the markets are telling you what they're going to do, and they're telling you well in advance what they're going to do. So all you can do is create problems for yourself by fighting what the market is actually doing. Okay, now in mechanical trading, okay, you cannot have any problem with psychological issues, because you cannot break the rules. No decisions to make other than the trading rules. Okay, decision making is consistent regardless of the trader's mental state. Okay, less room for emotions to impact trading. The time required to execute a system is short, so you can spend less time in front of the computer and more time living. And that is exactly what we want you to be. That's why our trades are only once a day, if there's a trade. And the longer we don't have trades, the more money we're making. And it removes the trader from the equation, okay, which is one of the most important things. But we also never get caught up in what happens intraday. Sometimes there's some panic moves, but overall, like if you look this week, okay, there's been some panic moves intraday, and by the end of the day, everything has solved itself back out. So these are the rules you have to follow, and if you can't, then honestly, it wouldn't be a product for you, because we first of all only want happy members. Number one. Number two, we want to have people that follow the rules, because we all share a chat room together for Q&A when people are new, or even people that have been around. I mean, it's our own private network of our traders and our members that hang out together. But to win at algorithmic trading, mechanical trading, you must have no opinions about the markets, zero, none, nada. If you avoid rule number one, you will lose money trading. A trend is the basis of all profit. If you do not understand this, you should not be trading. If you pay attention to news, you will lose money. If for 1 minute you think you know more than the market, price is too high or too low, the market will take your money. It will always punish traders with such hubris. We never sell at the top, nor do we buy bottoms. That is for fools who insist on being right as opposed to making money. The market is going higher and you are short. The market is right and you are wrong. If you're long and the market is going down, you're wrong. And that is 100%. Okay? I mean, you're losing money no matter what you think. If you have an opinion or you forced an opinion into the market, at the end of the day, when they mark your portfolio, that's how you did. And that's right, because the market is always right. Opinions never are. The objective in mechanical trading is to mirror the market. You want to always be doing what it's doing. And if you do, you will put the highest probability on your side, which trend or mechanical trading gives you a statistical edge you cannot obtain anywhere else. Okay? Profitable traders understand that edges are essential, and that is especially me as an ex-floor trader, okay, because I was a floor trader for 25 years. I understand that because on the floor we had, okay, the edge. That was the advantage of being a member. No, I no longer get that same edge because we don't get to clear the paper. We don't get to clear the order flow. The bid offer spreads are no longer, when I started, bid offer spreads were in fractions. Now they're in decimals, which are very tiny. So just keep these in mind, because that's the business is about developing an edge for yourself. Okay? Now, we always say the magic is inside you. There ain't no crystal ball. That's more my speed. Okay. All we want to get is long-term profitability. We know that any day, anything can happen. I'm not going to tell you what's going to happen tomorrow. I have no idea. Okay. I heard one of the questions about, is tech going to collapse? Yeah, it's going to collapse, but the question is when. Okay. The whole market structure is going to collapse for a while, just like it always does. But nobody knows when. It could be tomorrow. It could be a year from tomorrow. You cannot time when the bubble will pop. Okay. Right now, we're still anxious with buyers. You can see what's going on in many of these markets. So it doesn't really matter. Every time we've had some sells, they have come back. And eventually it'll be the statement you've seen maybe in trading places, that can't be right because the market will not bounce. In the meantime, we have a huge edge in the trend following methods. Okay. Now, our objectives are obviously, we always want to make money. We attempt to keep the variance small. Okay. Our portfolios are somewhat balanced. Okay. And we attempt to keep the drawdown small. Now, again, I can't always guarantee that. And again, you'll see every trade ever made in the system. You'll see weekly results of every week. Okay, we report every Saturday morning. Okay, the full portfolio and the status, whether we made money or lost money for the week, every single week. Every Saturday morning at about 3 a.m., you'll get an email with the update. Okay. Now again, obviously, I hope you don't are like me and get up that early, but I get up at about 2 every day. Trading emotions should be made as unemotionally. Trading decisions should be made as unemotionally as possible. And again, emotions kill. Okay. And I can tell you that because we had a saying on the trading floor: when you can see somebody's tonsils, which means they're panicking, give them whatever they want. They're wrong. That's always the case. Okay. When you see people screaming bloody murder to get something, it means they're wrong. Yeah. Now, in trend trading, price is everything. So you'll hear us talk a lot about price action. News is nothing. In fact, during the day, I don't watch. I used to once in a while watch when I was going to be on air, because I do Fox, I do CNBC, but I don't even watch anymore. Now I watch VSiN, Sports and Information Network, all day. Okay. You buy a stock when it breaks out of range. You sell a stock when the trend changes. Okay. Don't get out, and you never get out before the trend changes. And it happens. New guys, new members usually make that mistake first. They get a little nervous. In 2019, in October, Amazon had its earnings. They were horrible, and we were long the NASDAQ, and I got to get out. I said, well, listen, you can get out, but you better wait for the signal. Okay, because you're going to be better off. And of course, those who did get out gave up $50,000 more profit, because in 2019 we were long the NASDAQ about 48 months out of the year. So 48 weeks. Now we do and create a lot of synthetics. Okay, that is what we do here. We create, as a floor trader, there's a trade called a risk reversal. Okay, which was really, you were creating the stock itself by buying the at-the-money call, selling the at-the-money put, which really equaled the stock. But of course, as a floor trader, we had the big edge of no margin requirements like retail traders have. So we didn't have an issue there. But here, and in the retail world, we have an issue. So we have to create and add a third leg to create that synthetic. Okay. So when we're long, we buy a call and sell a put spread, okay, to finance the call. Okay, and still try to represent the stock, and the opposite, and when we're short. Okay, so we're never in open-ended risk. We're never naked short options. We're always starting our trades with the at-the-money options, because that is where the biggest edge in markets come, is understanding the at-the-money option, because the at-the-money option is also the determination and where all the liquidity lies. Okay, now I talk about family office. Now, you may or may not have heard of family offices, and usually they're for the very wealthy. Okay, you know, normal people like us don't get into family offices because they get special deals, they find special things to do, and they get better investment deals. Well, I created in my environment, we wanted people to be able to have the greatest benefit. Okay, and our community is, we're all very successful using it, the ones that are members. And we want people to be part of it, and everybody shares ideas, okay? But we do have just standard base portfolios that we run the same ones all the time, okay? And of course, I'm along with all the same mistakes. Does that sound like anybody, right? I mean, how many we've made mistakes, and of course, any mistake I talk about, I've made them more than once, okay? The only one I have never made was the emotional panic. Other than that, I've got a whole catalog of mistakes I've made. But why would you buy a stock when you can create a synthetic stock position? Okay, now, because we want to use and create leverage, okay, but we want to create leverage in such a way that we know it's a determined amount of leverage, so you know exactly what your absolute risk is at that time, okay, but you've got the potential upside. So every trade we have on has unlimited upside and limited downside. Okay, and that is the best side of any market to be in is unlimited upside, limited downside, whatever side of the market you're on. So if you're creating a synthetic long stock, okay, if you're buying a call and selling a put spread, if you're creating short stock, you are doing the exact opposite, buying the at-the-money put, selling the call spread. Okay, now either way. Now, one of the big benefits of these synthetic models is what? Well, sometimes if you've ever tried to short a stock before, you get the message hard to borrow, or you get what's going on now in the GameStop world when they shut people down, they wouldn't even allow them to trade. Okay, so this does not come into play, and that is where the derivatives market or the option markets allows you to create positions for yourself, okay, to then set yourself up to be able to leverage properly. And this portfolio you're looking at right now, this is as of Saturday, okay? This is as of Saturday, okay? This is what we call our 1A. The portfolio itself takes $32,000 to run, okay? We want you to have $96,000 in your account. Now, you're doing it yourself, but you need to have 3 times leverage. That is our number, 3 times leverage. And you can see that our dates of entry, the symbol we're trading, okay? Whether we're long or short. Now, we show the track record representing 1 share of stock because we have no other way to calculate profit and loss, because obviously everybody gets up at a different time. They put they put their trades on a different time. So the cleanest, simplest way was to just market by 100 by 1 share. Okay, so you just multiply the results by 100 plus or minus, and you'll get what our results are. In the meantime, for the 32,000 or the 96,000 in your account, we are actually leveraging $523,000. Okay, and you can see our returns in the far right corner. In Apple, we've made over $305 in Apple. Okay, interesting enough, and of course we cut the 3 major runs that they just had, but we've done very well, pretty much across the board. And we look for what we call mega trades, and mega trades are 20% or more, and typically we'll have 4 to 5 open mega trades. Now, right now you'll see the profit factor, which is down here. We trade 23 stocks here. Okay, this is the profit factor. It's 55 to 1. Okay, now again, that is ridiculous. It's a little bit too high even for us, but you'll see some that are even higher today. But overall, typically they're going to be 10 or 11 to 1. But the street celebrates 2 to 1. Okay, so that's what I'm talking about. If you understand profit factor, which is the amount of money you make for each dollar invested, that's where it comes down to. Okay, but the portfolio itself, since it started, this portfolio is up since its its inception, is up 902%. Okay, in 2020 it made 506%. Okay, again, I think this year we're down a little bit to start the year off. So, but this is the actual equity curve. Okay. You can see how we work from the lower left to the upper right, okay? And There's drawdowns. I mean, people that started here started out right up into a drawdown. Okay. And again, obviously, it always depends on when you start, but we also teach and do training a couple of times a month. And in fact, we're doing a training on Saturday because there's ways to actually even compound these up even further, because we have we understand when the right time is to press the portfolio or add contracts to the portfolio, because we want to take all advantage of all the information that we have in front of us. Okay. Now, we have a 2A portfolio, which is, it's $5,500 cost. It's a 16,500 margin, 3 times margin. You're leveraging 114,000. Okay, they're the same 8 stocks here are in the 1A. The 1A is represented in the 1, 2, and 3. Okay, and then I'll show you one more after that. But in the meantime, these are what's in here, and this is more predominantly an ETF model. Okay, and again, same thing, long or short, date of entries. Okay, the profit factor right now is 667%. Okay, 667 to 1. Again, that's obviously ridiculous. It was off a couple of good trades, but in the meantime, it'll vary, but it usually will settle when it's all said and done around 10 to 1. This portfolio, since it started, is up 678%, and of course, they only started at the end of in 2019. Okay, and then we have the equity curve, and you'll see all the equity curves again. You're going to get every result of every portfolio. Okay, and even if you're not in them, each week, okay, when you get your email, there's a total of 6 portfolios, soon to be 7, but you get to see them all, and you just get to pick the one you want to trade or be in, and you should just be consistently in the one that you want to be in, because that is really the best way to attack it. The 3A, a little bit smaller. Okay, it's 4,300, 13,000 worth of margin. You're leveraging up 79,000 shares of stock. And again, all it's done is we're taking a couple of stocks away, and we're trying to accommodate everybody so they can play and make money. I mean, again, it's, not everybody's got, let's say, 100,000. Not everybody's got X amount. It's everybody's got what they have. And again, we don't want anybody to start and over leverage. Even people that have lots and lots of money say, well, I want to do more. So start with one first. Okay, start with one contract first and one portfolio first, and feel it. See what happens. Make sure you understand all the dynamics of these portfolios, because it's very important that you feel what happens when it happens, so that you can then comfortably press your portfolio up. Okay, we like to organically grow everything. That is always our objective, is to grow organically. Okay, and here is the equity curve in the 3A. Okay, and then we have the 5A. Okay, now the reason I didn't show you the 4A, it's called the FANG portfolio. I don't use it, so I won't show it, and I don't believe in it. I think it's first of all, it's too big for most accounts. Okay, number one. Number two, the amount of grief it causes. Okay, if you're all susceptible to emotions, okay, it's a very emotional portfolio, because you've all seen how Amazon and the FANG stocks move around, and the price of those stocks. So we don't show it. I'd like to eliminate it, but I have a few people that still want to trade it, so I cover it, but I do not put it out or show it to anybody. In the meantime, the 5A is got 7 stocks. Okay, and these are more stocks, right? You can see Disney, First Solar, Skyworks, Western Digital, and then there's a couple of ETFs, and of course this one's up obviously gargantuan. Okay, in last year. But again, I don't want you to think we're promising those results. Those are what happened in the past, and based on our equity curves, okay, this is what we expect to be going forward, right? Lower left, upper right. We know, as I said in the opening, there's going to be drawdowns. So please just know that the portfolios have drawdowns. That's the way life is, okay? But win rate, we talked about this a little bit earlier. So why is your win rate so important? Because when you understand what your hit percentage is, it helps you understand the trade and what you need to do to make money. Well, our win rate is 66%. Okay, it's that simple. That's our hit rate. That's our win rate. Okay, and that goes across all of our portfolios and all of our products. Okay, so it's a pretty amazing number. Okay, and works, and that's what we do. So it is about being ready and prepared for all things that can happen. Okay. And if you want to learn how to create a synthetic, so just as an example, if you were looking to create a synthetic long an apple, for example, you would have bought the at the money call, sold the at the money put, and you would have bought a put $5 below. Okay, so in this particular case, you were paying basically 96 cents for the 130 call when the stock was at 130. Okay, your maximum risk here was 3.5%. Okay, you were representing $13,000 worth of stock with $596. Okay, this is the same as or equal to 100 shares of stock. Okay. Let's say we're going to do it. You were going to do it in gold. Okay, well, it would be very similar, right? At the money call. Okay, buy the call, sell the put, and then buy a put $5 below or whatever the spread is. You know, our spreads are different depending on the different stocks. I mean, you know, we carry, you know, obviously NVIDIA is going to be not $5. You'd go broke trading NVIDIA with a $5 spread, but that's, again, every stock, everything has been mathematically designed and ready to go. Okay, and of course, short stock, same thing, right? You want to short 100 shares of Facebook? Okay, well, great. Okay, sell the call, buy the put, and buy a call above. Okay, and I actually shorted this, so my number is off here, but in the meantime, it should be $10 wide. Okay, the debit is $377, so it should be $13.77 worth of margin or risk. So it's a 4.5% risk to be short 100 shares of Facebook. Okay, so again, this is the theory is always the same. The only difference that changes is the width and spread. Here's IWM, okay, with a $5 spread, with a $767 margin cost, okay, leveraging 26,000, okay, with a max risk of 3%. This is, again, the model that we create over and over again. And of course, we're doing this on 23 different stocks if you're in the 1A, and whatever various numbers you are in the others. And of course, you know, another little comment from somebody the last couple of days have made me realize how happy I am I found you. With all the craziness of the last few days, my portfolio seems to be chugging along. I'm also really learning a lot about options. Thanks again for offering your time. I believe this must be a life-altering experience. It must be kind of cool to think that when my wife and I retired, I thought of great fondness. I thought of you with great fondness, and I get lots of those all the time. But the big thing we've now added, okay, is the potential for automation. Okay, we have a broker that charges a flat fee of $10 a month. Okay, I pay. Last month I traded 32,000 contracts. I paid $10 in my commission. Okay, again, you don't have to go there if you don't want to. That's up to you. I'm not even going to promote it, but I'm just telling you we have their APIs, and we're going to add one more down the road. But right now, all of our portfolios can be, if you choose, automatically traded. Okay, and what that means is your portfolios are set up just like this. This is the 1A. Okay, and this goes. I didn't get them all in here, but this is the 1A. Okay, it shows you all the representation of all the stocks where you stand, and of course, what happens is you have to put on the first trade. Okay, that is your responsibility. But once you put your first trade on, the software will take on that from there. Okay, and the software will tell you what trade to put on. Okay, and all you do is match the software, and then from that point forward, it does the rolls when you have to roll forward. Okay, like, you know, February 19th expiration to March 5th. Okay, it does we do a lot of what we call 80 to 50 delta rolls. If we buy a 50, when it gets to 80 deltas, we roll back the 80 delta to a 50 delta option again, and we take some of that credit off the table because we always want to be able to realize some profits in case of a reversal, and we're not giving up that much of an edge to do so. Here's a SPY trade, okay, that went from, you know, it was a week roll, okay. Again, everything is set to your own personal, but this is all done automatically. Right now, my account does make trades while we're sitting here, okay. So the real question is, do you want to make money? Do you want to be right? What's your goals? Well, today I'm going to offer you, if you'd like to join me, be one of my members. Okay, so for you to take advantage now, it's $169 a month, normally $299. Okay, it's equity.com it's buffetttrading.com/equity, but you got to use the coupon code 4EQ month. Okay, if you want annual, okay, it's 4EQ year, which is $1,600. Okay, and this is, I can only take 50 people. I only take 50 people at a time because I want to make sure everybody's trained. But with today, you have the opportunity to choose. Again, this is only up to you, but full automation, $10 monthly commissions if you go. Okay, and that includes, and there's no charge for the automation either. Plus, you get my Monday night strategy call, which is every Monday night. I talk about the markets and the news and what's happening, and I actually teach how to read the charts, even though I'm using the algorithm, and I'll disclose the positions. Plus, I just finished a 6-session training course on options that you also will get all the recordings, and of course, along with that, I send the 2 books that I authored, in e-version. Okay, so that is my offer, and for those of you who really like it and want to go for the 2-year, we've never offered 2, but we have a 2-year now, which is $2,800 for 2 years. BubbaTrading.com/2-year EQ, and I will take all of your questions as I've got a few minutes, but I didn't want to overrun and not be able to answer any questions. So if you have any questions about anything, you can certainly feel free to fire away right now if you'd like. Okay, and what I'm going to do now, I've got a few minutes here. Hold on a second. I'm going to actually show you, okay, one of the portfolios. I'm going to show you one live in system right now. Okay, that is in trading right now. Okay, so here's them all. Okay, here's the 1A. Okay, and okay, here's all the positions. Okay, in the 1A, and if I go to any one of them, okay, I can look at the results. Okay, and let's say I go to Apple. So I'm going to view it. Okay, it'll bring up Apple, and I can go back because we email and text you. Okay, if you're using just the signals from the software, we will email and text you, or so we text you, you need to do this trade. If you're using the automation, it does it for you, but if you want to see all the emails and texts from this one particular portfolio, you can go back to, this has had 248 entries since it's been automated, and it will show you every trade that was made throughout since you were there. Okay, and of course, you can see here all the ups and downs, and it will go back obviously all the way through. So you can see where we started and how it rolls and how the models take care of everything for you. So you have nothing to do but follow the rules. That is what we designed because that's what we believe in. I think that it's by far the best for all traders. Now, just a quick, I'll tell you where all this was born from. Okay, we are also in futures. Okay, and we have futures models. Okay, that we have had for longer. Okay, and this is the original. This is the, as we call it, the granddaddy of them all. This isn't a futures portfolio, but this is, again, the algorithms and the design came from this. Okay, because some people aren't comfortable with futures for whatever reason. So we trade, and these are, I have all these businesses on right now, 29 markets here. Now you can see I go back to 2017, and I show you every single week of results since it started. Okay, and of course this is the equity curve on this is now the 350, used to be a 226, but we've got all sizes and range of these as well. But again, these are where it's all born from, because, and this is what you get to see under all cases, you always get the entire live portfolio and absolute pricing and profit or loss from the week before. Okay, and every week since inception. Okay, because that's what we're doing, is we want you to be able to understand how it works when there are losses, because like I said, there's always going to be drawdowns. It cannot be avoided. Here's the 1A live. This is, you can see all the results down the side. They're all designed the same way. Okay, we hide nothing. Okay, we share with you everything, because you can see all the results, and just like I said, multiply these all by 100. Okay, but in the meantime, so that's how you can join with me. And if you want to become part of the team and part of the membership, obviously we've got a great membership. It's BubbaTrading.com/equity, and for monthly, it's the coupon code 4EQ month. And if you want annual, it's 4EQ year. And I can only take 50, as I said, but look forward to those who want to become members. And I don't see any questions, so maybe Maybe I did a good job, or maybe you fell asleep. I'm not sure. or maybe you couldn't hear. Maybe that's why I don't see it. Hold on, let me see one spot. Oh, there we go. Okay. Do you take other spreads? Oh wait, that's from, I think that's from Keith, 1125, right? Okay, here we go. How do you use synthetic stock position for all portfolios you mentioned? Is the difference in 1A to 6A size? Yes. Oh, Marilyn, what's up, honey? How are you? Okay. The size is different. Okay, and the 6A is predominantly metals. Okay, because I do have a bunch of metals, people that like metals only. But it's the smallest, and it's a bunch of, it's a bunch of silver mining and whatever stocks like that. But they are all, each portfolio has its own value, and it's from, the minimum is 5,000. It's 5,000 to 96,000 is the size of account you're going to need to make it work. But everything else is all automatic. Okay. What is the difference between a synthetic trade and okay, well, that's a good question. A collar, when you collar a stock, okay, you already own the equity, okay, and you're collaring off. Collars are used for a tax base. Like if you wanted to sell a stock that you had a huge profit in, but you didn't want to pay the taxes this year, you could collar it now. You'd have no risk, no reward. It'd be over. Trade's over, but you'd be collared because if you own the stock, it would mean you'd be short a call and long the put, which is what a collar is. It's an absolute no more movement. Okay, those are also known as either reversals or conversions from a trader standpoint, because we used to trade those. When you could get the edge, they were profitable for traders who could get an edge because you can make money. But when you're using them, they're typically only used if somebody's either deciding that they can predict the market or for tax reasons. In other words, you want to sell the stock, but you don't want to pay tax this year. You want to buy off for a year. Okay. Do you use synthetic stock positions for all? Yes. Now you can use real stock if you want. Okay. But again, obviously, the amounts of dollars you're talking about, $500,000 in the 1A. Okay. So you'd need, you'd need $1.5 million to do all stock. Okay. And the other problem you would have with trying to do all stock is when you're doing short positions, not all stocks are easy to borrow. Okay. So, believe it or not, even the spiders are hard to borrow, which is, I find that unbelievable, but it is what it is. Okay. So in the meantime, again, if you'd love to come, what is an API? Oh, an API. What is an API? What is the API, or what is an API? And the API is just how you put your code in. But in the meantime, we do very well. We're very comfortable. We're very happy, and we've got, we retain approximately 90% of our members. So, again, it's just simple. It's all right there in front of you. There's never any, nothing is illiquid. There's not these imaginary trades. We're all in the same stuff. Okay, we all do the same trades. And again, trades come out, if there is a trade, okay, they come out at 3 o'clock in the morning. Okay, they're emailed to you. You don't have to do anything with them, but because obviously you can't. But in the meantime, I think my time is just about up. Okay, so with that, I will say hello to Anna again, and thank you so much for having me. I wish I had more time, because you know me, I could talk forever. But again, anytime if you got any questions, you can reach out to me at bubba@bubbatrading.com. And I'm always around, and usually I usually answer in less than 10 minutes. Okay, so it's bubba@bubbatrading.com. And as always, I thank you all for your patience and listening, and nice to see you, Marilyn. In the meantime, I will turn it over to Anna.
Thanks so much, Todd. Can we please double check the link, because I wasn't able to open it.
Okay, you know what? It does work, but if anybody has a problem, just email bubba@bubbatrading.com. I will send you a different link. Some browsers don't like these once in a while, so I always exceptions. So if you just email me, I will immediately send you a link together. But these do work, okay, or at least they did when I tried them. I can't promise it at this moment, but again, some browsers have troubles with it once in a while. But there has been a few that already got in, so You know, again, like I said, if you had a problem, just email me at Bubba, B-U-B-B-A, at BubbaTrading.com. That's Bubba, the name of my company, at BubbaTrading.com.
Well, this is Mark from Right Line Trading, and I'm going to have to move fairly rapidly because I have a fairly large amount of information to give you. What I'm going to be showing you is our Compass trading system, and just quickly with this disclaimer that all signals and trading opportunities that we provide are for demonstration and educational purposes only. Everyone should understand that trading in the futures, forex, and stock markets is risky, and that a person can lose a substantial amount of money. You can also make a lot of money, and we hope that's the way it goes for you. Always carefully consider your financial position. And those of us here at Right Line are not registered financial advisors. We're not licensed commodity trading advisors. Now, I'm going to do a really quick recap. Let me start off by giving you a little bit of a snapshot of my resume. I graduated from an Ivy League university. I went to the University of Pennsylvania for 8 years. I graduated with a degree in mathematics. And within the field of mathematics, I specialized in the optimization of closed systems. I work with the U.S. Navy in optimizing underwater decompression schedules. For that, I was awarded my diploma with special distinction. I graduated summa cum laude. After graduation, I was inducted to the Phi Beta Kappa Honor Society. You have to graduate in the top 2% of your class. Subsequently became a full-time professor at Thomas Jefferson University in Philadelphia. Thomas Jefferson is in Center City. Penn is in West Philly. I published 15 peer-reviewed articles in top-tier journals, and I really do consider myself first and foremost to be a scientist, a teacher, and an academician. I mentored more than 30,000 traders. I've taught an innumerable number of undergraduate and graduate students. I've spoken internationally in many countries. The last place I spoke was in Manila in the Philippines. Locally, I spoke in Dallas, Fort Worth, both last March in Dallas, Fort Worth, and the Philippines, the end of March, beginning of April, right before the COVID outbreak. And I just got out of there in time, or I might still be there. Now, if you're here today, you probably have a problem on the trading. And the problem is that you have good days, but then you have bad days. And the problem is with consistency. You may have blown several trading accounts. You may have purchased expensive software in the past that just hasn't worked. But hopefully, you'll decide that this may be your last stop. Now, I did the same thing back in 2004. I bought $15,000 software. Back in those days, I had to wire the money to the company. I couldn't pay by Visa, MasterCard, or even by check. And I blew a really enormous account. And so what I decided way back then was the only way that I was going to trade profitably was to create my own software. And I created the software based on mathematical modeling, which is my area of expertise in applied mathematics. So what I'm going to show you is a software and trade methodology that I don't think that you've ever seen in the past. Now, I have 500 traders in my live trading room, and we make money almost every day. I'd say 8 to 9 out of every 10 trading sessions, we make money. Now, if you stay to the end of the presentation, it's obviously only 45 minutes, or minus what I've done. You're going to get really a lot of bonus software. You're going to get a huge special discount, and I'm going to give you a really nice bonus. Now, I just want to really briefly review what everyone's been trading. Now, remember that 95 to 98% of day traders and swing traders ultimately wind up going broke. They wind up blowing multiple accounts, and that's because the underlying mathematics of the trade methodology and the indicators they use simply don't work. And if we go back 400 years to when the Japanese rice traders created Japanese candlestick patterns, what was their underlying premise? The premise was that the power of every buyer was essentially equal to the power of every seller. So if you had rice, 100 kilos of rice, 100 buyers on one side, 100 sellers on the other side, just like the market, a bartering, traders bartering back and forth, deciding whether that rice is going to be bought or sold at what price. Their premise was that every single buyer and seller in the aggregate had the same power, that no single buyer or seller had the power to overwhelm any others. And from that, we got Japanese candlestick patterns. They're really elegant. They've been around for 400 years, and price action traders have never made any money. That 95 to 98% failure rate remains. The reason is because in today's market, what the Japanese rice traders presumed, that the power of every buyer equals the power of every seller, is no longer operational. So this has really no predictive value off the right edge of the chart. Little to none in terms of telling us how price is going to move when we have to decide if we're going to trade. And that's because it's the big institutional money that's in control now. And who are these institutions? It could be a 401k, a mutual fund, a hedge fund, a big bank, Bank of America, Deutsche Bank, HSBC. It could be JP Morgan, Goldman Sachs, and probably 100 other institutions that I'm not mentioning. The key is, though, they wield so much money, and when they get involved in the market, we as small retail traders have no say in the direction that price is going to go. And the only thing that we have the ability to do right now is to create chaos, chop, total disorder. It's when the big institutional guys step in, and this is operational in the futures, every Forex pair and every stock, whether it's a small cap, mid cap, or large cap. It's the institutional money that is going to determine the direction of price, not us. If we don't respect this single dominant force in the market that determines the direction of price, we are going to get consistently run over. Now, here's what we do. We're in the market. Institutions have stood down. What do? We create just really essentially a mess. We want to stay out of the market when this is happening. And that's what our software allows us to do. When big institutional money comes in, buys the market up, we want to ride their coattails long. Institutional money sells the market off. We want to ride their coattails short. Our goal as a day trader and swing trader is not to get winners. Our primary goal is to avoid losers. The difference is if you trade with sensitivity, you're trying to get every winner. If you're trading with specificity, you're trying to avoid every loser. And it's a specific mindset. And you have to sort of retool your mindset. And if you can sidestep the losers, the winners will fall into your lap. Now, I want to briefly talk about pattern trading. Now, falling triangles, rising triangles, J-hooks, channels, these are all patterns created by us as small retail traders. We have sequential lower highs equal lows, anticipation of a bearish trend continuation. There's so many things wrong with this pattern on a mathematical basis. I just don't have time to go over them. The key is, though, is that we are creating this pattern. We as small retail traders, big institutions don't do this. And here's what happens if we anticipate a bearish trend continuation on every falling triangle pattern. What they do is they're going to wait for the price to break out to the downside, and then they're going to take the financial instrument long. Because if they stop us all out, which is really one of their primary goals, then price is going to move further for whatever amount of money they put into the market. Because as they stop us out, If we're short, we have to buy back our contracts, buy back our lots, buy back our stock, and help propel this trade to the upside. So they do watch everything we do. And if we create a falling triangle pattern, if it's created, and then we trade the breakout, it is not unlikely that they're going to come in and sweep us away. So we always have to trade in the direction of institutional money, and pattern trading is simply not going to get us where we want to be. Now, just quickly, Fibonacci, same thing. Fibonacci was a 13th century mathematician. He created Fibonacci transformations. From these, we get Fibonacci numbers. Then we got Fibonacci retracements and extensions. You know, I would argue they never had any validity. It's sort of magical thinking to think that these define areas of market sentiment. But in today's market, it's a moot point. Institutional money does not give a hoot about Fibonacci levels, and they're going to drag price or whip price right through them. I mean, this has cost traders more money than any other indicator I think that's out there. Now, so if we sum up, if we cannot trade price action or price patterns or Fibonacci. Elliott Wave and Gann created formulas to describe market sentiment. They're brilliant formulas, but in today's market, where big institutional money rules, again, big institutional money couldn't care about Elliott Wave theory, Elliott Wave or Gann theory. Finally, divergence signals. We can never call a top or a bottom. We can never take a divergence signal. A top and a bottom is created by big institutional money. When they take an instrument to the long side, it's going to continue long until they step aside. And what they love to do, step aside, all the retail traders take it short to try to get that retracement to mean, and they come step right back in and they push it further along, and they create what I'm sure everyone knows is the bear trap. The bear trap and the bull trap are top and bottom formations, and are constantly costing us money, on and on and on. So we got to eliminate all of this stuff. This has been costing day traders their money, 95 to 98% of them, for I would say close to 75 years. Now, institutional money comprises 70% of the volume of every single financial instrument. And you know that if you see a small cap or a mid cap, even a large cap, take a really big move, you always see it's on 4 times or 5 times normal volume. Where's that excess volume coming from? It's the big institutional participation. So we have to respect this force. And if we don't, we're going to get stopped out. These are our allies. We have to ally with them, and we have to look to run over every other retail trader out there. And there are tens of thousands of them. Now, there are 3 key metrics that determine money flow. The big institutions are not going to step up and let us know if they're going to be taking Google long, crude oil short, gold long. What we have to do via mathematical modeling, determine proxies for money flow. And they are volatility, trend, and momentum. And I'm going to show you how we do the assessments. Now, this is the full platform, and you're never going to get caught in the wrong direction. The only thing you have to do is look for the appropriate entry, and it will set you up and take you in the direction that institutional money is pushing price. Now, the first thing that we have to define is market structure. Market structure is as important as price action is as unimportant. Now, here's our 50 EMA of our EMA. It's a proprietary line. This is a 15 EMA of an EMA. It's another proprietary line. When the 15 is green and up, and the 50 is green and up, and the 15 is green and up, and price is above them both, we trade long. When the 50 is red and down, and the 15 is below the 50, and price is below both, we can only trade short. We cannot take a short trade in this area. That's one of our trading rules, and it saves us a tremendous number of losers. It's big money that creates this kind of structural alignment on multiple time frames, and that is what we look for. Now, we also have to define pivots, areas where prices turned previously, and what we do is we define 3 major swing pivots. This is an area of resistance. It gets broken, price comes up to another resistance area, it holds. It turns price. Then price slides along here as an area of support, finally breaks it, comes back up, it's an area of resistance, and we trade it short. We never take a trade into a pivot. Again, it's another way of avoiding losers. Now, we could put a lot more pivots on or have no pivots. What we've done is we've tried to strike a happy medium in only projecting the 3 major swing pivots of the day. Now, Laguerre momentum is a really important force that moves price. Now, the reason we use the Laguerre as an oscillator, and it's really in the same basket of indicators in which you have RSI, fast stochastic, slow stochastic, the Arun oscillator, Williams R. They're all essentially the same, and then sort of an outlier is the Laguerre. All the other indicators were meant to track divergence, and we don't believe divergence is ever going to be a top caller or a bottom caller. It doesn't work anymore. This only tracks momentum. And what is momentum in the markets? Let me check my time here. Okay, it's something that very few traders understand. Now, in real life, if a car is going around a racetrack at 150 miles an hour, momentum is constant. It's neither increasing nor decreasing. But if the driver hits the gas pedal and accelerates at 10 miles per hour per minute, momentum is increasing. If he hits the brake and he decelerates at 10 miles per hour per minute, momentum is falling. But in the markets, momentum is nothing about speed. When the oscillator comes up and locks long at the 100 line, now we've cracked open the Laguerre, we've changed its gamma, we've changed its smoothing factors, and its percent K line is going to move different than any other oscillator out there. I used to have a slide where I would have 5 oscillators stacked on top of the of our Laguerre, and it's really quite different because it's not a divergence-seeking tool anymore. It's simply a momentum tracking tool. And what it's telling you is that there's sequential increase in buying pressure. That's what momentum is in the financial markets. And what is happening is inside in each candle, the close is squeezing towards the high. Close is squeezing to the high, pushing up to the high, pushing up to the high, pushing up to the high. And what you want to trade is a market that big institutional money is increasing buying pressure on. So when the Laguerre starts to head up and then locks at 100, everyone else who's looking at an oscillator would look for divergence to fade the market. We love it when it's at 100 because we know that buying pressure is so strong that the markets are just going to rise. When the Laguerre heads down, we have a sequential selling pressure increase. The close is approaching the low. That's momentum in the markets. It's a very, very powerful tool. I'm going to show you why it's a leading indicator. It gave us a $40 trade yesterday on GameStop. Now, I don't have that projected, but here's where it's leading. You go from oversold to overbought, and price trades in consolidation. Now, consolidation is a very, very important part of market structure. So what's happening is your big money is accelerating buying pressure here. Within each candle, the close is approaching the high on every long candle. So in the aggregate, buying pressure is intensifying. But overall, price is moving sideways. What you're going to get is an explosion out of consolidation to the upside. I'm telling you, this is the most reliable signal I have ever found in trading market structure. It's the break of consolidation on this indicator, and I call this the Laguerre price divergence. Yesterday we got it on Tilray. We got a $40 move. Oh, I'm sorry, on GameStop. Now here it is again off of GameStop. Price is moving sideways. The oscillator goes from oversold to overbought. It's still in a channel. You can take it long any place. Well, the system is going to give you the long entry anyway, but you're going to get an explosive move to the upside. Now, we're in the process of creating an indicator that will actually signal you into the trade. And you're going to see that we're always adding new tools and ways to help you trade. And it's very likely that when you see this, the system is already going to signal you into it. But I just wanted you to see how powerful the Laguerre is in predicting the future direction of price as being a leading indicator, not a lagger. Now, bias is extremely important. The only thing that creates a multi-time frame alignment and trend is big institutional money. Now, I hesitate to call it a multi-time frame alignment because you don't have to be trading a time frame based chart. You could be trading tick, range, Renko. So what we do is if you're trading time on a 5-minute, we look at 5 times 3 is 15 and 15 times 3 is 45. So this assessment is looking at the 15-minute and the 45-minute, and it's got this market structural setup. The 50 and the 15 are just like this, and prices above them both. So you don't have to create or look at multiple higher time frames. This is doing that job for you. And it's a tremendous advantage. You trade in the direction of this multi-time frame bias, you will never get caught trading against the direction of institutional money. Same here to the short side. It's doing that multi-time frame analysis for you. Now, if you're trading range, let's say you're trading a 5 range, Fibonacci does have symmetry in nature. It's going to be looking at the 8 and the 13 range. The 2A are fib numbers. Trading a 377 tick, it's going to be looking at the 610 and the 987. Now, I wanted to put that slide in here. I just didn't have time to do it. It's called the triple screen analysis. So most of our indicators don't assess data from our trading chart. They assess them from the 2 higher multiple charts, whether they be time-based, range-based, or tick-based. So we always trade in this direction. Now, this is a really unique indicator. It's called our C2 indicator. Okay, now, the best thing to do is just show it to you. Now, what this is doing an assessment of momentum and an assessment of chop. Now, we've completely modified the chop indicator on Thinkorswim. It's an open source indicator, and it was just really lousy. And what we do is we do this assessment of the 2 higher multiple charts. We don't do it on our trading chart. We look at momentum off the 2 higher multiple charts. It's a triple screen analysis. Now, on this move up, chop is decreasing and momentum is increasing. So the thickness of the line defines the strength of the move up. As it gets thicker, you know that price is really going to fly. Now, when it gets thinner, you know that chop may be increasing, momentum may be decreasing, but overall, the trend itself or the power of the trend is waning. When it rolls to the downside, you get a change in your directional bias. And it's always heralded by an arrow. And sometimes these arrows give us great entries on the system. Let me see how much time I have. I'm sorry. Okay. I think I'm moving in there. Moving good. So we're always trading, obviously, in the direction of the multi-time frame or the triple screen assessment of momentum and the triple screen assessment of chop. We want chop falling, momentum increasing. We want chop falling, momentum increasing to the downside, to the upside. This C2 is really a powerful indicator. Now, I just wanted to show you one entry. There's the entry. It's GameStop all the way to the downside. Now, where you take it out, we're going to go over in a little bit. This is just your entry. And you can see how when it's really thick here, you're going to get a nice move. And when it thins out, that's when the trend is, getting a little bit long in the tooth. Now, we have a scanner that's going to scan you into trades. Now, it will scan anything you want. The NASDAQ 100, the S&P 500, 12 Forex pairs. I created a PDF, which I sent out to my traders, of the 10 best Forex pairs to trade, the ones with the most volatility and the most volume. I put it on a PDF and we sent it out yesterday. Or you can trade multiple futures markets. Now, this scanner is looking at everything that I showed you. It's looking at market structure. It's looking at the multi-time frame direction trend. It's looking at the C2. It's looking at everything. And that first green line is going to tell you to get in the trade long. Now, it may give you sequential signals, but the best time to get in is off the first one. Now, you're going to be able to do that relatively easily. Now, here is it. I don't know why I got hung up on GameStop. Here is your first signal short. Now, you're going to get sequential signals short, but this move down, when it's very mature, and I'm going to teach you what overbought, oversold is in the trading room. It is not based on an oscillator. It's based on the number of standard deviations that you're trading off a mean price. As you move one standard deviation off, you're okay. But between 1 and 2 standard deviations, you start to have problems because price always wants to retrace back to mean. So you want to take the trade right at its inception and not as it matures. So although these are perfect setups and tell you that you may be in for more short, they're riskier trades. Here's where you want to get in. And this is where the scanner will sort of go off on you first. Now, here's the whole system. I just wanted to show it to you. This is on Penn Gaming. I have it in my options portfolio, so I just threw it up there. And now I'm going to show, this is the scanner. Now, don't get concerned about it because this was late in the day. And what's going to happen is, let's say you're going to look at 30 stocks on your hit list and you want to scan them, and you can pick a 5-minute, a 10-minute, whatever you trade, a 5 range, 377 tick. It's completely configurable. So you're going to put 25 stocks in there. Market opens. Nothing is going to be up there. Then you're going to see your first stock pop up. That's going to tell you that you're going to be getting a signal if the candle closes in the direction it's headed. So to give you an example right here, if you pop over here, this is a 5-minute candle on Salesforce.com. You have 5 minutes to get into this trade on a close of the candle to the upside. Plenty of time. So let's say you open the chart, you open the scanner, it's empty. The first thing that pops up is CRM in the green. You open up the chart on CRM, you're going to see this line. But you don't take the trade until this candle closes to the upside. When it closes, you're in long. So you got plenty of time to take the trade. Then ultimately, you're going to see a second stock pop up. You're going to go to that stock. And if you're trading a 2-minute, you got 2 minutes to get into the candle or get into the trade. By the time it's 4 o'clock in the afternoon, stocks will have come and gone. And I picked a day where the market was in a strong uptrend. You see the Dow's up 3. Looks like the The Nasdaq's up 167, the Dow's up 332, the S&P's up 41. So you're going to be left with a lot of stocks that are still firing long signals, and a few that are firing short signals. It's very easy to follow, and it gets you into great trades. Now, the entry price is exact, the exit price is exact, all the targets are pre-configured. Now, here's a full trade. I wanted to show it to you. This is on Roku. And here's the roll of the C2. And you can see that you obey market structural law. The 50 is heading down right here and here. And there's that first scanner signal. Now it's off this arrow. It waits. I think it's either this candle or this candle until you fall below the 50. The 15 crosses the 50. The 50 is already red, and you can look at the C2. It's a perfect entry to the short side. Now you're going to hit support. You have to decide whether you want to close the trade at support or let it rock. What I usually do is I tighten my stop at support. And I make sure that I lock in profit. If you're trading options, I'm going to teach you how to do that in the battle room that I'm going to put you in for a year. And what you're going to do is you're going to set your targets. What we like to do is 50%, 75%. You're going to take, if you got that 50% winner out on your weekly option, you're going to lock it in, and you're going to try to get 75% on your second. If you don't get it, the worst that can happen is you're going to lose it at 50%. And I'll show you how to configure all of that. But here's your entry. We're going to game it. We're going to break it. We break it here, and we're going to take the trade out right here on a break of the 15. Now we can go right back in on a scanner signal right here, take it down again. Right here, we can take it down again. Just be careful that you don't trade an oversold market. Every one of these would have given you really nice money on a weekly option, and it would have given you really nice money if you bought the stock. And on the other trades, I'm going to show you how much money you would have made. Now here's a $45.48 move up on Tilray. Bias is green. There's the C2, and it comes with a scanner signal. And look at the year. It's locked long. So you've got tremendous buying pressure. And actually what you've done is, I didn't draw it out, but you've taken this off of the oscillator price divergence. Price has gone from oversold to overbought. Tilray just sat like a lump, didn't do anything. You finally got a roll of the C2, which is chop and momentum, gave you the arrow, you're in, you already have price, the momentum locked to the upside, buying pressure is really intense, and you get a $45.48 move on Tilray. Now, I'm just going to mention this really quickly because it's more for options traders. This magenta line is historical volatility. This cyan line is implied volatility. It tells us whether we want to buy the option or sell the option. And if we want to take a weekly, maybe if implied volatility is really way higher than a historical, we'll sell a bull put spread, take a really nice juicy net credit, and if the underlying stock rises, we're going to get to keep a lot of loot. And this is really for options trading. Now here's a move up on Penn Gaming, same thing. Now this is not an absolute entry to trade it, although you can take it if it adheres to all of our rules. It does, so it becomes an entry. The scanner will not signal you in for one candle. For some reason, it's waiting. So you'd be in one candle late, and you're up on Penn Gaming. You had 100 shares, you make a 487. You have 1,000 shares, you make 4,870. If you're trading a daily or weekly option, you're up a bucket load. Now, let me just check my time. Okay, I've got 13 minutes, I think. This is one of our big, I'm giving you trades we took. We took this short on Clorox on an option, and we made a ton of money. There was your scanner signal, the gear lock short, tremendous selling pressure, multi-time frame alignment and trend to the downside, market structure, C2, 50, 15, and we got a great move on Clorox, $7.26. And I'm telling you, we really racked it on the options trade. And I kid you not. If I didn't do it, I wouldn't say it. I didn't put in the amount here. Here is Take-Two Interactive. Now, here you get the entry right with the scanner. This is a very powerful dual entry. And you can see it is exact. It's perfect with our market structure. Our 50 is up. Our 15 is up. Price is above both. And look at our C2, heading up. Momentum is accelerating to the upside. Shop is decreasing to the upside. We never really break the 15, and Take-Two is all the way up. I don't know exactly how much money it made, but we traded Take-Two, and we still have Take-Two in the options portfolio. Now, today is a really rough day to the downside, but these days occur. Now, here's Tilray. It's another trade on Tilray, $7.47. And here's Chewy, which I like to trade all the time. If you waited for the scanner signal, it would come right about here. Here's the C2 signal, which you can take. You've got that multi-time frame alignment and trend. You've got the oscillator heading up. There's your entry. Whoops, up you go for 506 on Chewy. And I really like this stock, and I traded a lot. Now, again, we hit resistance here. You tighten your stop. You've already locked in profit, and you let it, and it happens to break it. You will never take a trade into a pivot unless you have space to get your first target out. And it's really bad to trade. You know, if you're tight to a pivot, you're just not going to take the trade. Here's a 45.70 trade on MicroStrategy. Is terrific to trade. It's just really choppy, and I give it a lot of leeway. C2 entry, scanner entry, up you go. Now, I just wanted to focus in here. If you trade options, it's really a useful tool. In fact, I consider it to be something I can't trade without. Now, this is Thinkorswim, and so obviously you can go in here, and if you go to the options chain, you have the option to configure it so that implied volatility and historical volatility are projected. But they're only giving you implied and historical volatility that's operational at that second. And here you get a look back, which you cannot get off of the screen. So you can see that implied volatility is significantly higher than historical volatility. So you want to sell your position and not own it because it's really expensive. Now this is on NVIDIA. So I think it's the most powerful software trading methodology available to the small retail trader because it always puts you in the direction of big institutional money. Only big institutional money can create this multi-time frame symmetry and trend. We have 3 time frames heading up. Only big money can create this C2 moving to the upside like this. We as small retail traders can do nothing with this indicator. So, and also the Laguerre as a leading indicator is only jockeyed around by big institutional money. And the scanner puts it all together for you. Now, we're offering it, I'm gonna have to go through these quickly because I don't have a lot of time left and I don't want to run out. We're offering a really special discount and 2 additional educational programs and additional software package to the first 10 traders who come aboard. There are a lot of traders in the room. There are well over 150 traders here, so there's a lot. If you have any interest, I said put your number in the chat box, but you're not going to be able to do that. So what we're going to do is what you should do is give us a call. Now, I haven't given you the price. I haven't told you what the add-ons are, but if you want, I would jot down the number because at some point in the future, you may decide before I'm over that you want to do it. Now, I put the link, I put the purchase link in the room. Thank you, Rory. Now let me go through what you get. First, you get the scanner. We have tons of traders who buy it as a $999 add-on. You get it for life. It's not leased, it's yours. If we make it better, we give you the improvement. You're going to be in the battle room with me for 1 year. It meets on Tuesdays. It's scheduled for an hour. It has never gone less than 3 hours. Right now, we're doing trading. We're doing options trading. Right now, we're on vertical spreads. We're going to move to calendar spreads, then more complex options positions. We use our software. We look at implied volatility, historical volatility. I really show you the right way how to trade options, and I show you how to leverage unusual options activity. Now, a lot of traders say they use it, but I'm telling you, it's a real bear to grab hold of. I'm going to show you how you can use it. I finished 2020 with 34 straight options winning trades. This year, I had 7 in a row, and now that it's broken because I had a weekly timeout on Dropbox. But you're going to be in this for a year, and it's a really an intense educational experience. We have a couple of hundred people in the room, but chat's open, and you go back and forth with me and all the other traders. It's a very supportive community, and you're going to get a ton out of it. Doesn't mean you have to wait a year to trade, but in a year you're going to have an awful lot of information that no one else has. Now, you're also going to be in the trading room for a month. Now, a guy by the name of Victor Allen published a study. We pulled it out of Trader's World. I don't even know who he is. He looked at a million trading rooms and all these historical records, and he put us in the top 10 for transparency, proven track record, likelihood of assisting traders. I can tell you, I trade with Chart Trader. I trade with my stops and targets projected. And the profit loss on every trade I take is projected into the trading room. At the end of the trading day, I go over every trade that I take. And you see my back end. You see my profit loss, not on some calculated Excel spreadsheet, but right off my back end of my software, of the platform. So we are incredibly transparent. Now, I have some testimonials. I don't have time to play them. So I have Retivia. She's been in the room forever. I've been using Right Light Trading software. This is the best software I've used. Mark continuously works to improve it and to make everyone a successful trader. This is hands down the best educational trading software on the market. This is Ron Mell. He's in the room every day. I've been trading for over 13 years. I learned something new. Mark is outstanding in the live trading room. I pull every trade out in advance, way in advance. You will get into that. The workspace is very intuitive. It's easy to learn. You saw it. It really the learning curve is astronomically high because you're going to be in the room a month. At least the first 10 traders will be. Now here's we made 180,000 in 2020 on options. That's right out of my thinkorswim platform. In futures, we made 162,202 trading 2 contracts. We look at 6 charts, but for the most part, we trade the E-mini and we trade the NASDAQ. Everyone gets the rapid results quick start guide. Everybody gets the kind of support that I really want you to have. We're always here to help you. Me, Rory, Sergio, Giovanna, Prashant. We're gonna work with you, and we're always here. Now, if you make it, it really is financial freedom. And I just want to quickly show you, this is me, so you have a face behind the voice. This is my son. I'm a single father. I live in South Florida. I have no family here. My family's all up north. I raise this boy by myself. I do his laundry. I cook his food. I make his bed. I take him to school. And the only way I could do that as a single dad without any family to help me out is by mastering this discipline. There's the only way. It gives me the flexibility and ability to be a hands-on father to this great kid. He's a wonderful boy, and that's why this discipline is really such a blessing. Now, the investment is $997 per year, but I'm just going to go right to the offer. And I'm going to skip even these. These are testimonials. Stefania is my buddy. She's unique lingo. But, you know, other traders try to bamboozle you. Right line is amazing. The exits, the strategy were programmed. But what you're going to get for this webinar only is you're going to get the software lifetime. You're never going to pay a dime. That includes upgrades and add-ons. If we make the software better, and we're always adding new add-ons, because mathematical modeling is always about improving your software. Your software is never good enough. There's always something to help you define the movement of price off the right edge of the chart. Rory, do they need to enter the promo code? You don't need to enter the promo code. Now, here I have the first 20. So we'll go with the first 20 instead of the first 10. 1 year in the battle room, 1 month in the live trading room, and the market scanner. The only recurrent charge will be 50% off after 1 month in the live trading room if you want to stay. It's totally your call. If you think it's worth the cost of doing business, then you let us know and we will put you in. But we're not going to rebill you unless you let us do it. You're not on an auto bill. And the special gift is my Trader's Aptitude Accelerator. And here's our phone number. It only goes to the first 10. Now, let me just really quickly, in 30 seconds, look at any questions that I can answer. Hang on 1 second here. Okay, hang on here. I think my glasses off because I'm so nearsighted. All right, I'm going to scan really quick. I don't think there are many questions. Okay. Hey, Rory, Grant Wilson wants you to call him. Okay, and can you see the chat room? You got to come in really quickly because there's an email address. Hey, Betty, what considered as unusual options activity, Betty? I mean, I really don't have the time to describe it to you, but I'm going to teach you what it is in the battle room. And it's a special metric that tells you that something strange is going on with an option position. Maybe somebody bought 5 million shares, $5 million worth of it. Maybe somebody bought incredibly out of the money positions. It really, really takes a few hours to explain, but it's a very powerful sign that institutional money is behind the options trade. And that's what we want to do. We want to get behind trades that are supported by the big institutional guys. They always know more than we do. And I can tell you some trades I took off of UOA that, honest to God, will knock your socks off. We have one right now on Bosch and Loam. It's already up 100+%. It doesn't expire until January of 2022. I took a $20 call, a $20 strike price position. It's now trading at 31, and we're deeply in the money on it. And I did it because somebody placed a $15 million Bosch and Loam call at 20 with an expiration of January 2022. I followed their lead, and that's the tip of the iceberg of what UOA is. Yep, Brativia, a member. Did you have an outline of all the classes? I don't have an outline, but you will get a link of every class we've ever had, all of the battle room classes in the past, and they come with a header. And the header pretty much gives you the topic that I'm going to cover in that particular battle room session. Chris, it works on Thinkorswim or NinjaTrader 8. I didn't show you the NinjaTrader 8 version, but it works on either platform. The NinjaTrader 8, the NT8 version is a little different, but it's just as powerful. And they're both really powerful systems. It works for swing trading. Remember, and this is really important, trader. This force is an instrument-dependent, time-independent force. It does not matter whether you're day trading, swing trading. I mean, I take positions on options that go out 6 weeks, 8 weeks, 12 weeks. I take them all off the software. I use daily candles, and it really will give you great signals. So it works on any time frame. If it didn't, it would be something wrong with it. It's not time frame dependent, and it's not instrument dependent. And anyone who gives you anything like that, has to have some inherent flaw. Hey, Betty. I can't. Well, I did the best I could, Betty. I mean, I'm telling you what it is it's evidence that big institutional money is at work, and I wish I could tell you. Okay, great. That's the best I could do right now. So thank you so much for giving me your time. I don't want to run over, I really, really appreciate everyone. I really appreciate you for hosting me and giving letting me present. And thank you so much, everyone in the room, for giving me your time. Take care, everyone. Hey, thank you, guys, and have a wonderful, wonderful afternoon. So I'm going to sign off. And again, thank you for hosting me. Bye-bye.